facing major structural changes related to aging, digitalization, greening of the economy. But more importantly at the moment, we hesitate between uncertainty, unpredictability, unexpectedness, the unknown. And with all that, we have to deliver on our mission, price stability. So if you're interested in those issues, come to the ECB Forum in Sintra. We will debate all that and more.
Hello and welcome back to day 2 of the Forum. This morning, we want to delve into the vastly changing landscape of global trade, examine how the shift away from banks is impacting the financial system, and then conclude with a conversation about central bank communication. The first session, like yesterday, will be chaired by ECB Vice President Luis de Guindos, and it will be on what the rapid expansion of private credit means for central banks. We'll then move on to a second session that looks at how world trade is being upended. And this second session will be hosted by Piero Cipollone of the ECB's Executive Board. I'd now like to invite Mr. de Guindos and the panelists for the first session onto the stage. Thank you.
How are you? Nicola, how are you? Good morning, everyone. Thank you very much, Claire, for the introduction. We're going to talk about the non-bank financial intermediaries. It's becoming more relevant in terms of the funding of the economy, but simultaneously it has attracted a lot of attention because of the potential risks for financial stability and the question of the interconnection with the traditional banks. No? Under this category, we find a space that covers many different animals. I will not use the quote of George Orwell, but there are quite different animals in terms of their characteristics and in terms of the supervision and regulation. To analyze and much more in detail this topic, we have your paper and presentation by Loriana Pellizzan, professor of the Goethe University and at Ca' Foscari University of Venice. Welcome. Loriana's paper will be discussed by Nicola Cetorelli from the New York Fed. So, you know the housekeeping rules, 20 minutes for your presentation, 10 minutes for your remarks. And so, without further ado, please, Good. Loriana, take the floor.
So thank you very much for inviting me to present this work. It's a joint work with Riccardo Mattiello that is also here. He's a PhD student at Ca' Foscari University of Venice and Warwick, and Jonas Legel from the Leibniz Institute SAFE. I'm very happy that, thanks to this opportunity, I went back to work on a topic that I worked quite a lot 10 years ago, or more, 15 years ago, on non-bank financial intermediaries, mostly on US data. This time, I try to use mostly European data. And as you can see from the title, what we are trying to investigate in this paper is the growth of the non-bank financial institutions and their implication to financial stability and monetary policy. We are asking 4 different questions, quite challenging, as you can see. The first, how large is the financial system in the euro area, and how does it compare with the US? The second one is, how much are the euro area non-bank financial institutions supporting the real economy? And then how they are going to reshape financial stability and monetary policy transmission in Europe. And under this question, I also try to address another important topic that it has been debated quite a lot, that is, should non-bank financial intermediaries access or not on the central bank balance sheet? And the question is, should they access or not? Should they access on the liability side, on the asset side? And I will have just a few things to say about this. And then finally, we are going to investigate how could the non-bank financial institution in Europe help or benefit also from the capital market union or the savings and investment union. I'm starting with this graph that is representing the total financial system in Europe according to ECB data. And you see on the y-axis, there is these percentages that indicate pretty much how much the total asset that you are going to sum up for all the different financial institutions that you have in Europe look with respect to the GDP in Europe. And as you can see, banks that are the light blue represent about 2 times the GDP, with an increase till 2008 and then a significant reduction, but quite stable around 2 times. Then you have clearly the intervention of the euro system, but then in green you have insurance company, in blue you have investments, and then in orange you have these other or remaining other financial institutions that all together, as you can see, has been grown together with the banks till 2008, and then later on continue to grow even if the banking sector in some sense is going to, with respect to the GDP, reduce, and reaching a peak of 8 times the GDP in 2022, and now we are around 7 times the GDP. So clearly, already looking to this picture that clearly is just, the sum of a lot of total assets that can be intra-group or, let's say, intermediation, it is quite interesting. So it's telling us that really the financial system in Europe looks quite large. If we are comparing it with the US financial system, and in this case, I'm using data from the 1980, but after the shadow part is exactly from 2000, you see that in terms of GDP, there was this growth till pretty much again 2008. And then after 2008, it remained quite constant, 5 times the GDP. Banks are still in light blue, representing just 1 time the GDP in the US, and the rest, is significantly important pension funds, so the composition is also different with respect to the one of Europe, insurance, money market funds, and so on. So clearly, these 2 pictures are telling us quite important things, that in both cases, the financial system is very large, and that non-bank financial institutions do play a significant role in both these systems. If we're focusing on the non-bank financial institution and just look to the pattern, the numbers are telling us that in 2000, there was a significant difference of the non-bank financial institution between the US and the euro area. But then, as you can see, they look quite similar. So after 2014, pretty much the 2 percentages in terms of GDP are quite similar. And the question is, how can we have all this, let's say, significant amount of total asset that represent all these non-bank financial institutions? And the first question we are asking is, where are they investing? What are these non-bank financial institutions, helping maybe the real economy? And this graph now is in trillion, so I'm just giving to you not in terms of percentage of the GDP. For Europe, as you can see, non-bank financial institutions are also interacting a lot among each other. So for example, insurances are investing on investment funds. So clearly, these total assets are summing up this way. Then there is a significant also interaction with the banking sector, and there will be then Nicola going to stress maybe this aspect more. And then we have that the amount that is devoted to lending, for example, to non-financial corporates is the light green, that is not so large. There is also not too much investment, or at least, is a fraction also investment in government. If you are asking the same question for the US non-bank financial institution, the picture is quite different, and is this one. So again, you have a lot of interaction between non-bank financial institutions, but you know, they are also lending a lot to the householders. They are lending a lot, look to the green part, to the non-financial corporates, and the part that it is in gray, that is the rest of the world, is quite small. Instead, if we go back to Europe, you see the significant fraction of the European non-bank financial institutions are, in most of the case, investing their money abroad. And when I'm saying abroad, the significant fraction is the US. So already these graphs are posing more questions than the answer that I'm able to give to you. And I'm trying to provide, you know, some potential reason of why we are observing this type of pattern. So why do we have that the financial system in Europe is so large, but is investing so much abroad? And, you know, I just provide several reasons. The first one is that when we look to the GDP and we see that they are looking quite similar, it's not that in trillion they are similar, because we are talking about 50 trillion versus, you know, let's say 100 trillion or 80 trillion. But the fact is that the denominator is quite different. We have lower GDP growth in the last period in Europe with respect to the US, and this is, you know, producing this effect that the non-bank financial sector is 3.8 times the GDP in Europe compared to 3.3 times in the US. Another reason is that the financial system in Europe is having a lower access to the capital market, and also we have a longer intermediation chains that clearly is going to pile up the total asset. Because one thing is that you get direct access to the capital market, or there is a lot of intermediation that by creating this chain, of course, it can be efficient in the way in which the resources are allocated, but on the other side, maybe if there is some problem in one of these elements of the chain, you can have some spillover effect. Then it is very high also because, you know, the non-bank financial institution in Europe has to allocate a lot of saving. In Europe, we are saving more than in the US, so there is a lot of investment that need to be done. And then there is also that these savings are largely managed by global asset managers in Europe as well. And we don't have the big champions, as we don't have champions for banks. We don't have champions for the non-bank financial institution, and like, for example, BlackRock. And then the other thing is that there is already this huge debate, so it's not that I'm the first one going to point to this, but we have the capital market that is underdeveloped, is fragmented, is segmented, including also the sovereign bond market. There was already some debate about this yesterday. And I'm sure that if I'm going to talk with any of you, you will have a lot of other reasons. So I'm not going to debate which one it is the most important and so on. But the focus that I want to point is that clearly the non-bank financial institutions are an opportunity. It's true, they can be very risky, but we need to consider them also as an opportunity to develop the capital market. And so far, they are a missed opportunity because most of this funding, for diversification reason, because the stock market in the US is more developed and so on, are largely invested abroad. But, and this means that clearly we need to try to think better on how we can, exploit these opportunities. And clearly having a better saving and investment union not only will help all the economy and so on, but will help also non-bank financial institution capital to be invested, at least in a fraction, in Europe. And another thing is not only that the non-bank financial institution will benefit by having a very nice, large, developed capital market in Europe, but they can help to develop the saving and investment union. Because there is one characteristic that is going also to explain why yesterday REFET were telling us that the corporate bond market is far integrated in Europe. Because the non-bank financial institutions in Europe, they do not face cross barriers as banks are facing. And to show this, I'm showing to you this graph that looks quite complicated, but is very simple, and is coming from one of my former PhD students that is now at the ECB. And what they did using the fantastic database that they have, they were looking how much the investment funds in Europe are collecting money. So on the left-hand side, you see the investor countries. And with the different colors, you have all the money. Where are this money going? So the country incorporation of the funds, not surprising, are largely Luxembourg and Ireland, but also the other. But then the money are again reinvested quite a lot in a diversified way in all the different countries in Europe. We don't see a significant home bias as we are usually thinking about investment funds, apart from the fact that a significant fraction, of course, is going abroad. So clearly, this means that the non-bank financial institutions in Europe do not face the classical border, let's say, limitation that the banking sector is facing. So how can we try to use better this possibility? And the usual thing is that we need to enhance the capital market infrastructure. So if we want that they are also helping credit in Europe, we need that to have maybe more covered bonds or asset-backed securities where they can invest. On the other side, maybe we should think to have a better market in terms of private credit and private equity. I know that there is a lot of debate on it is good or it is bad, but the fact is that so far, the European non-bank financial institutions are investing in private credit and private equity in the US. And we don't have data. We have no capacity to figure out what are the risks that, in terms of maybe the benefit, that we are facing on this other part. So clearly, I think that if we want to debate and figure out what are really the source of risk, and now I'm starting to talk about risk of the non-bank financial institution, the first thing is that we need to understand better what they are doing abroad. Because as you can see, a significant fraction of this total asset is invested abroad, with implication for systemic risk, but also implication for monetary policy. And I'm going to talk about this later on. In the paper, I don't have the time, but in the paper, I investigate the 5 traditional indicators for systemic risk, that is size. And clearly, they are not individually very big, but if you are putting all together, and the fact that they are interconnected in a chain, they are big, and they are highly interconnected. And as I said, I'm leaving again to Nicola the space to discuss about this. I investigated also the 6 other specific indicators that the Financial Stability Board and the IOSCO indicate as relevant for non-bank financial institutions, and I can mark that the most one is risk concentration and links to core financial institutions. But then we need to remember that the European one, in terms of systemic risk, face 3 other challenges. One is opacity and data gaps. Because if you want to investigate if they are facing some risk, you need to have the data to try to figure out where is the risk, what is the exposure, and so on. And then we have other 2. One is the inadequate supervisory coordination and fragmentation. And on this is the pretty much where is the country where these non-bank financial institutions are located. And the orange is Luxembourg. And then you have Ireland and Netherlands. So clearly, we have a concentration in some countries of all this funding collected across all Europe, and we don't have yet in Europe a unified supervisory mechanism. So again, if we want to supervise systemic risk, we need to have a unified, let's say, way to look to all these different entities. And then the third one is that after several events, starting from the US in September 2019, then we have March 2020 and so on, we know that if there is some turmoil in the market, central banks are intervening. And this clearly is creating an expectation to the financial system in general, not only to banks, that there will be a backstop. This is clearly, inducing mostly non-bank financial institutions to engage in excessive risk-taking under the assumption that there will be some rescue. And this has been already discussed in the paper by Czeslak and Annette regarding the Fed put. But then there is this beautiful document produced by the ESRB Advisory Scientific Committee about the market maker of last resort. And, you know, we need really to figure out that central banks now do have, in some sense, the capacity eventually, you know, to intervene under also this other hat. This is moving me in the last 3 minutes on the role that they have for monetary policy. And, you know, in the paper, we are discussing about the different channels. You can call them in different ways. I'm sure that we can discuss a lot, but I focus on one of them, that is the interest rate channel. So the capacity that the central bank are having to control the short-term rates, and then that then will have an impact on the rest of the term structure. And there is already ample evidence that non-bank financial institutions are providing a significant footprint, not only in Europe, but all over the world. And based on this, I'm also talking about central bank access, giving access to their balance sheet to non-bank financial institutions. So the way in which I'm going to investigate this question is by looking to this dispersion index that is measuring the dispersion of the rates in both the uncollateralized and collateralized general collateral and special collateral repo market for Europe and for the US. I want to thank, in this case, Iman and also Benoit that give to me this data. And as you can see, in Europe, it's not that you know, the central bank is not able to control this interest rate. The dispersion is not so large, but is a little bit different than the one that you have in the US. And according to Duffy and Krishnamurti, this is due to the fact also that the non-bank financial institutions do not have access to the central bank balance sheet. The reason is that in Europe, we do have a lot of other problems regarding this. And the first is that if you're looking to the repo market, the special collateral, we have scarcity that now is reduced thanks to the increase of the interest rate. We have scarcity of the different collateral. So this graph is showing to you that with respect to the deposit rate facilities, you can borrow at a far lower rate if you are giving as collateral one single specific German bond. But you get the same also if you're using an Italian bond. So it means that really the use of collateral, sovereign collateral in Europe is allowing you to get a rate that is lower than the deposit facility rate. And it's not just, you know, one rate. It's a lot of rate. This graph, again, is coming from a paper of Benoit Noyen, Davide Tomio, and Andrea Poinelli that, you know, is showing to you that this dispersion depends a lot on when you are transacting and with whom and so on. So clearly, there is a lot of dispersion on top of the fact that there are fragmentation, market power, and so on. But the question is then, what can we do? If we want to keep everything in the corridor, is there any chance that maybe we should give access to non-bank financial institutions to the central bank balance sheet? And in order to investigate this question, we look first to the facilities that are in place. One is the overnight reverse repo facilities that is in place since 2014 in the US, but it has been heavily used after 2021. The contingent non-bank repo facility by the Bank of England, never used. And then we are asking, but I don't have too much time, are these two facilities helping to reduce let's say, the dispersion we have in Europe? And the answer is no. You need something else. You need the security lending facility. What it is that the bond that the central bank is holding is given as collateral in exchange of cash to the system. In this way, you will have the possibility to put a cap to the, or better, a floor to the short-term rates. And therefore, you know, the on-RRP for Europe is not helping us to reduce this dispersion, but only the possibility to have collateral scarcity reduced Or if we want to put a cap on the corridor, then maybe we can think to what the Bank of England has suggested. So the suggestion is for collateral scarcity, extend the security lending facility to a lower basis point from 20 basis points now to 5 basis points as the US, and maybe to some other entities. And for stress episodes, start to think to have a dedicated contingent non-bank financial institution repo facilities, of course not to everyone, but to key non-bank financial institution participants under an appropriate regulation. And this will help us to have also better data about this non-bank financial institution. To conclude, we need to develop the saving and investment, also to channel all the money that we have invested now in non-bank financial institution. We should have a better covered bond market, maybe having the same structure as the European data warehouse is doing for securitization. Strengthen the supervisory framework under a supervisory mechanism. And then, if we consider important to maintain everything under the corridor, expand the security lending facility and the contingent non-bank financial institution repo facilities to key non-bank financial institution participants under the appropriate regulation. Thank you very much for your attention.
Nicolas, please, go ahead.
All right. Thank you, Luis, and thank you for including me in this event. Right, let me start with the usual reminder that what I'm about to say represents just my own views and not necessarily those of the Federal Reserve Bank of New York or the Federal Reserve System. All right, let me jump right in with a very curated summary of the paper. This is a very rich analysis that Loriana and co-authors put together in, I think, in a very short amount of time. Congratulations on that. So it's a curated summary because I'm going to just pick and choose liberally on specific aspects of their analysis, on things that resonated with me and my own understanding of NBFI evolution and things that I want to base my remark on. So on the growth of NBFIs, we learned that, yes, there is a commonality in overall trends between Europe and the United States, but there are also important differences. There are structural differences. The euro area is much more bank-centric, historically so. This has a lot of implications, many of which Loriana talked about. There's one point that I wanted to mention that she only alluded to very briefly in her remarks, but in the paper is mentioned. The fact that, in fact, because of this bank-centric structure in Europe, in fact, there is a significant footprint of non-bank financial institutions inside banking firms. And this is something that I'm going to talk about toward the end of my remarks. On financial stability, I'm not going to say much here. These are well understood trade-offs. I'm just going to leave the bullet points here. Again, structural challenges in the euro area, I think, is the important thing to take away from Loriana's remarks. The monetary policy, I want to spend a few seconds on this. I thought it was very intriguing, the point that they make that we could use NBFIs as a potential vehicle to overcome some of these challenges in the euro area. That's absolutely interesting. And I'm stressing here, highlighting this point, and I put it as a with a question mark. Should we allow non-bank financial intermediaries to have access to central bank liquidity? Is that a necessary step? So now my remarks. So what I thought it would be actually useful for the consumption of this audience is to add even something extra to the already rich analysis that Loriana and co-authors put together. But what I hope I will achieve is to take a step back and, while this is an incredibly complex, very heterogeneous set of institutions, Luis was alluding to this very big group of animals, maybe it could be useful to take a step back and simplify, go back to very, very simple questions related to NBFIs, and really, ask why do we actually even observe the emergence of non-bank financial intermediaries, and how is that growth sustained, right? So these are very, very basic questions, and I promise you these are not trivial questions to pose. Hopefully, I'll convince you in a slide or two. And my goal, my hope is that if we can identify some common principles, some basic economic forces that can explain those questions, then we may be able to actually develop some sort of a coherent and, in fact, jurisdiction-neutral view perspective to interpret the evolution that we have been observing both in Europe and the United States. So I'm going to offer just one principle for this discussion, and it is summarized in the title of this slide. NBFIs are naturally dependent on banks. So if there is one thing that I hope you will take away from these few minutes of discussion is this point, okay? So let me try to spell it out. So we are talking about institutions that are not banks and engage in intermediation activities. That means that are engaging in maturity and liquidity transformation. And we know that a necessary element of the business model of an intermediary is to manage liquidity risk. Okay, that's the essential component of the business model. And we know that intermediation is intrinsically fragile, intrinsically unstable. How do we know that? Well, we can look at banks, no? Traditional intermediaries. How do banks manage liquidity risk? They have access to stable funding sources. We have 150-year give and take of modern banking history to try to answer this question, right? So they have access to stable funding, but I would say that in large part that stability is the result of the granting of collective guarantees, right, behind those funding sources. And that's actually not even sufficient, right? We have learned the need to actually also give privileged access to these intermediaries to lender of last resort facilities, right? Very, very basic points that I'm making here. So now we have non-bank financial intermediaries that do not have, at least on an ex-ante basis, access to liability guarantees. They don't have access to liquidity facilities. So now you understand why I think it's a fundamental question that what I was asking before. How can they be successful? How can we observe this growth absent this very necessary ingredient for their stability? So maybe society have been able to engineer some new form of intermediation activity that I'm not aware of. And I think it's actually much simpler than that. They can buy these services, and who can actually provide those services? Banks. That's what banks have done from the beginning of times, right? Very, very simple point that I'm trying to make here. But I think that the implications are quite profound. So that's a conjecture that myself and my co-authors have actually sort of entertained for a number of years, and then finally we have been able to bring it to the data, and I think that there is strong evidence that there is this intimate interconnection between banks and non-bank financial institutions. This is looking at data from the United States. There has been a massive increase in this liquidity support from banks to every stripe and color, really, of NBFI types, okay? And again, yes, I'm looking under the lamppost. I have access, privileged access, really, to data from the United States. But this point, this evidence is actually mounting. You may have seen a lot of references in the news, but also other economists that increasingly are stressing this point. And there is also evidence that you can see here in Europe as well. So we can use this principle to now go back to these fundamental trends that we have observed, that Loriana and co-authors have analyzed. On growth, I would just make a very simple point that perhaps asset growth per se does not tell the full story, right? If you're willing to concede the fact that, at least in part, that growth is supported by banks, right? So it's not really a story of substitution of NBFIs growing and banks somehow losing ground. It's more a story of banks transforming their role. I'm not going to say that, but you could say that it looks like the banks are somewhat moving in the shadow of intermediation activity. And so you can perhaps even draw in a hypothetical counterfactual, which is that absent this bank support, perhaps we would not be observing this significant growth of NBFIs. Financial stability implication, again, I'll go very quick here, just put in the bullet points. The obvious implication is that it's even more complex, no? That there are even more channels of risk propagation and amplification, and banks themselves actually can be a vector of instability because of their intimate connection to NBFIs. I want to close with a couple of slides on monetary policy considerations to go back to this fundamental question. This is the elephant in the room on any NBFI discussion nowadays, right? Should they be granted access to central bank liquidity? And I think, again, the standard trade-offs are well understood, and Loriane and co-authors do a fantastic job in covering all the bases. You know, eventually, it's a trade-off, and hopefully we could do this to achieve these goals for monetary policy, trying to minimize the moral hazard, right? But let's assume that you can do that, and I'm going to venture that actually that may not be a stable equilibrium, right? Why am I saying that? Go back to my principle, the one that I was stressing a second ago. Giving access to NBFI, to central bank liquidity, effectively is going to sever that connection with banks, that dependence on banks. And you could say, well, maybe that's a good thing, right? Maybe. But the implication of that, you may actually reduce what has been really the uniqueness and the specialness of banking institution. And I would venture in suggesting that maybe that would do it for banks, right? You would actually now observe the debasement of banking institutions. But that too may not be the end of the story. Why? Because presumably banks are not going to sit idle observing this process. And I can imagine that they would actually mount some strong lobbying to, invoking leveling the playing field. Now, all of a sudden, you have these fierce competitors that would have access to the same privilege, lender of last resort, one way or another, but they're not subject to the same strict prudential standards, right? So my point is that we may be observing an equilibrium which is kind of a race to the regulatory bottom, that maybe that's what we want collectively, but let's analyze all the possible implications. My final point, I'm out of time, maybe there is an alternative approach, and I go back to the original point. If it is true that there is actually an important component of NBFIs inside banking group in Europe, maybe we can leverage this model that is prevalent in the euro area. And we could provide the conditions for the growth of NBFIs inside the banking groups. Why would that be? Because maybe we could achieve the best of the both worlds. I'm very optimistic here and provocative, and we could debate that. On the one hand, we could have the growth of these specialists that might be able to support the capital market development and the reduction of the market segmentation, et cetera. But then all these intermediaries would be subject to homogeneous prudential standard by virtue of being inside the banks. And so these liquidity needs, this fundamental point that I was making, would be internalized within the conglomerate, and that would be possibly a positive thing. By the way, this was the prevalent model of operation in the United States for decades, up to the global financial crisis. There was a very significant non-bank footprint inside bank holding companies. And it is the case that actually intermediaries inside US bank holding companies were less reliant on central bank liquidity in times of stress because they could use these internal synergies. I conclude. I was just a word of caution. This is not. I'm not suggesting that banks are at the center of the universe. It's actually the opposite, right? I'm recognizing that the system is so much more complex, but we need to absolutely put front and center the fact that there is unavoidably a symbiotic relationship between these different types of institutions, and this is not an accident, it's not a bug of the system, it's actually a structural feature, and if we focus on that, maybe we could develop also the right insights. Thank you.
Thank you very much, Nicola. Loriana, I don't know whether you want to react briefly.
No. I perfectly share the presentation. Yes.
Are very
Yes.
I have a question for both of you. Is because one of the issues that you have raised is the possibility of having access to central bank money. But don't you think that before that we should have a sort of macroprudential toolkit? Well, non-banks is a very mixed bag. No, you have from pension funds to hedge funds, going through private credit, private equity, and these kind of things. No, but now perhaps the discussion about the access to the central bank money is much more focused on money market funds. But here, we can see that the regulation, the lack of a real macroprudential toolkit for money market funds and mutual funds is not an obstacle, or perhaps we should have something before. Huh?
Of course,
That.
So thank you very much for the question. I think that there are a few things that we need to consider. First of all, as you said, and it's not that simply you give access to any type of institution. They are quite different. And I think we need to understand better what they are doing before to decide also, we want to regulate in one way or in the other. Regarding the money market funds, in the US, they have access to the liability side of the central bank. So pretty much they can deposit, but differently than banks, they deposit and they get collateral as in exchange. So it is different than the reserve of a bank. First. Second, it is done only for money market funds that are investing in government bonds, short-term maturity government bonds. So before, in the US, they did this regulation to create this type of money market funds, and only to these money market funds, they give access to the liabilities, in this case, of the central bank. The question is, in Europe, do we need this? So in Europe, the money market funds are very tiny, first. They are not investing too much in government bonds. They are investing a lot abroad. I didn't have time, but it is well described in the paper. So clearly, the money market funds that we have so far are not the ones that are getting access now in the US. But they are already posing a significant challenge to the banking sector already in the US. Because when the Fed really changed the interest rate at which they were going to remunerate this cash deposited by the money market funds, what you can immediately see is that a huge increase of the deposit at the money market funds and a reduction of deposit at banks. That has been then created the run that we know with SVB and so on. So clearly, in the banking sector in Europe that is very bank-centered, creating all this competition will, I think, create more problems than the one that they solve. This is why I think that we need to have and to think carefully to the facility that will help the transmission of monetary policy as it is in Europe. We cannot just copy the US because in the US they are doing this.
Thank you very much. And Nicola, one question for you. I think that is very interesting, what you have commented about the interconnection between banks and non-banks. But there is, I think that my impression is that the segment of the non-banks that is growing, more quickly is private credit, and private equity. What's your view about this phenomenon?
It's the poster child of what I was describing, actually. And I'm glad that you are bringing that up. Because it's really hard to talk about NBFIs in general because it's an undefined set, right? So let's focus maybe on specific segments. And private credit, on the surface, if you look at it, it looks like it is a model of intermediation that is fundamentally based on equity funding, right? They have very, very minimum leverage. In fact, in the United States, business development companies at least have very strict leverage restrictions. So that's true. But then they make loans, right? So they are exposed to exactly the same kind of risk that I was describing in my discussion. So if you look at it, it looks like maybe, yeah, we have engineered something new that allows them to be intermediaries somehow without performing liquidity transformation. Well, if you look actually more closely, they are extremely reliant on banks for their business. So they need a lot of liquidity. So they rely on credit lines for their business. And you know, the fundamental reason for it is that exactly because they are, you know, their activity is based on equity and capital calls from their investors. It's very hard to manage capital calls. Even if you're an investor in a private credit fund, the fact that this fund actually has subscription lines of credit that the fund can use to manage temporary liquidity needs is actually giving these investors an extra incentive to put the money in these funds. So yeah, actually, it's that same story.
One question, you know, about private equity. You know, perhaps you know they are not extremely leveraged, but if you look at the companies that they invest,
yeah,
these companies are extremely leveraged normally.
Oh yeah.
So leverage is something that we need perhaps a holistic approach with.
No, exactly, and that's the point that I'm making. Now, so they are taking a lot of risk because their clients are clients that are going to need themselves a lot of liquidity needs, and so these providers of credit, the private credit firms, will have to satisfy those needs. And again, banks' support is actually fundamental for them.
Thank you very much. Now we open, you know, we will start here by the center. I see Vito, please to the point, Vito, and concise if possible.
Vitor Constancio, former ECB Vice President. Thank you very much for the paper, which is very rich in information, and also for the discussion by Nicola. Very useful. I have a comment and a quick question. The comment, which also contains an implicit question, is that you highlight, and it's absolutely factual, that these non-bank financial institutions invest a lot outside Europe, you know, picking savings in Europe and then investing outside. What you treat academically as a fact in policy papers from the Commission and reports and so on is portrayed as a complaint that Europeans save a lot and then a lot of those savings are invested abroad. But the causes for that are not just microeconomic causes, as you mentioned. It's also the result of the macroeconomic regime that we have that generates a current account surplus around 3% of GDP, which by definition means that we are exporters of capital to the tune of 450 billion a year. And so someone must be the vehicle of those exports of capital. So what do you think about that macroeconomic perspective on that point? The question is about securitization. It's in one of your recommendations, and it's also a big point in the Compass Commission program, the securitization. But it's not happening, securitization. So my question is, what should be done to change that? Because there is an issue there. In the past, the banks had a self-interest in doing securitization because they would save capital and all of that. Now they have capital well above the minimum regulatory level, so they don't need to securitize for that reason. And also the transformation ratio of banks is now much lower than it was, so they don't have, apparently, they don't see many alternatives to then expand the balance sheet or other things if they get rid of some assets that they have in their portfolio. So do you really believe their securitization could really be jump-started, and what would be the recipe to achieve that? Thank you.
Thank you very much, Vito. Xavi and Joaquin. Xavi.
Thank you for the nice presentations. I have two common questions. The first is that, is the classification of the non-bank financial institutions useful? I think there are too many different animals inside. And so maybe we should advance to the next step to differentiate them. So from the money market fund to the private equity to the pension fund, there are very different regulatory regimes behind. So I don't know. I question a little bit the generalization, and so I don't know. Want to know what you think about that. And the second is on the Nicolas alternative approach for Europe. I understand your idea for the US, but for Europe, for a system which is bank dominated, and where banks put barrier after barrier to the entry of market-oriented whatever, mutual funds, which are much cheaper sometimes than the services of the banks, etc. So I think it may backfire because it could reinforce the dominant position of banks in Europe, and in fact do not bode well for the capital market unions and for the progress towards more also market-oriented finance in Europe.
And finally, Joaquin.
Yeah, thank you very much to both of you. Very interesting. If it looks like a duck, swims like a duck, and quacks like a duck, it's probably a duck. So what I would like to say with this, that many NBFIs, they act like a bank. And I have a very clear view about this. The consequence should be that we regulate them like a bank. And we are lagging behind here. All, let me say, other consideration, trying to find an interim way, at the end, I believe they will not be very helpful. We should regulate them much more strict, much more robust, because you alluded to that in your presentation. All the things they're doing, they have so many similarities to a bank, and they have this interconnectiveness to the banking sector because of the liquidity lines. So we have to do much more on this. This is my clear view here. Thank you very much.
Thank you very much, Joaquin. Now, Oriana.
Yeah, so thank you very much for the different points. Of course, yes, regarding the fact that, if we are indeed a lot of savings and in the international. So, but the question is, why are we doing it via this non-bank financial institution? It can be done in another way. Is it efficient? So clearly, this is another paper that will be nice to write. In fact, after all this analysis that I have done, I have already a plan of several papers. So it's not that this is the end. Actually, it is just the beginning. Regarding securitization, I do see that securitization can be done only via banks because they have now the access to the small and medium enterprise. We can start, in any case, I don't have all the data, but there is signals that, for example, covered bonds now has been done not only in Germany, but also in other countries. So this is why I was pointing more to this rather than the classical securitization. On the other side, we have a lot of credit, let's say consumer credit, that is growing. And the question is, what is going on? We have all these consume today and pay tomorrow. All this part that is maybe done via this securitization, we need to figure out better what is going on. So there is space for this. I don't know if it is good or bad having this in Europe. But on the other side, so either the firm in Europe do not need more credit than the one provided by the banks. So this is the key question. Or if they need, we need to find a way that, banks are intermediating this, but this firm will get credit in some other way. Regarding the, well, I think that Javier is mostly asking to Nicola, so I'm leaving this to him. Well, they are indeed doing the same things as banks. Should we regulate them? Well, maybe the answer is yes, but the problem is that, if you're looking to what is going on in the rest of the world, they are growing, they are making a lot of profits, and a lot of funding in Europe are going to the same institution abroad. So the question is, what is the smart, let's say, response that Europe has to give in this case, because we can continue to regulate everything, but you know, the risk will be abroad, and we are investing abroad and taking in any case all the risk. So I think we need to go more deep on why we are investing all this money abroad, and where are this money going, and what are the benefits for Europe.
Nicola.
Yes. No, I want to start with Joachim point first. It's funny you mentioned the ducks. I used that once, that metaphor in a presentation, and it put me in a lot of trouble. So I'm glad that you are doing it. Yeah. And yes, I think you are touching exactly on the fundamental point. You know, if it is a bank-related activity, I think we need to have an honest adult conversation about that. So I would totally agree with that. Xavier's point, yes, it's an incredibly heterogeneous set of institutions. And so maybe the institution angle is not the right way to approach it. Maybe focusing on the functions, the activity might be so much more relevant, and it would maybe also take us, eventually to the same point that we are discussing, right? On the European exception to what I was describing about, the financial conglomerate model, I think at the end of the day, you may be right, and obviously, I take advantage of my role as discussant to just put stuff out there. You don't have to believe it, but no, seriously. So one of the reasons why Europe seems to have this, fundamental structural challenges with banks, also being so severely home biased, I think it goes beyond the nature of the banking business per se. I think that there are frictions in the European Union that somehow foster this segmentation. One of such frictions, I think, is the fact that there has never been a completion of the union, right? So there is a fiscal element that is missing. And I think it's going to have implication for market segmentation and also for the way how financial institutions operate. And so, in a way, I guess these challenges are bigger than just related to the financial institutions at play. If I look at the history of the United States, in a way, United States used to be a highly balkanized system, right? The banking system. The United States used to have effectively 50 separate, banking markets, right? And so the process that led to, also a much higher level of integration of markets went as a result of that, that deregulation at the state level that facilitated movement of capitals across states and et cetera, the developments that I was mentioning about. So there are some necessary steps to be taken, to Luis' point before you actually approach, things that are related to institutions.
Thank you very much. We have only 2 minutes left, but I see Richard and Olli Rehn and Pierre Gouche. So we close, please.
Congratulations to Laureata on a very comprehensive paper. There are so many issues here. We deal with a lot of them, of course, in the European Systemic Risk Board. And we publish every year the Non-Bank Financial Intermediation Risk Monitor, which covers a lot of these issues. So I will pick out only one, and that is supervise them like banks. Yes, but these institutions operate transnationally. They are supervised by the national competent authorities, not by ESMA. Mm-hmm. And how could you, and I think this is the question that I would put coming out of this, how could you give non-bank financial intermediaries access to the ECB balance sheet without effective European Union level supervision? I just can't see that.
Thank you very much, Richard. Olli, please.
Thank you, and thanks to Loriana and Nicola for very insightful presentation and discussion. I particularly welcome your emphasis on the positive role that the non-bank spectrum can play to enhance capital markets in Europe and the savings and investment union, without forgetting the financial stability considerations. My question relates to a driver of financial system today, that is stable coins. And we are on the, as Richard actually has been working on this, for instance, on the European Systemic Risk Board, we have been quite concerned about and closely monitoring the development and integration of mainstreaming of stable coins to the US financial markets. What kind of systemic risks do you see, you assess this could cause to the financial system of the euro area, and what kind of reforms or policy measures you consider most urgent to tackle this, so that we ensure that they don't undermine financial stability or monetary sovereignty?
Thank you, Oli. And finally, Pierre.
Thank you. One remark and one question. The remark is on securitization. What the banks told me in Belgium, at least for mortgages, is that their margins are too low, so they would not be able to sell that to the market. And the margins are low because they use it to attract customers to get cheap deposits. I don't know if it extends to other countries, but it might be part of the explanation for why you don't see this growth in securitization. My question is actually sharing my confusion, because we've had two papers, one yesterday, one today, that actually tend to show that the markets are, despite a lot of impediments and fragmentation, working quite well in Europe. So I'm wondering how big is actually the problem of lack of savings and investment union. And as much as there are different kinds of NBFIs, maybe there are different kinds of issues with the savings and investment union, and we should be more disciplined in having those discussions separately, because otherwise we discuss something that is so broad that actually we are not discussing anything. But it looks like it's not so bad, actually.
Thank you, Pierre. Loriana.
See, so thank you very much. Well, regarding Richard, of course, I share perfectly the fact that, before to talk about giving access to central bank, we need to have information and a good supervision. So I subscribe the fact that the fragmentation we have so far in Europe about supervision is something we need absolutely to change, and the fact that mostly for non-bank financial institutions, at least we start to share information. Because at the country level, there is still this problem. But these non-bank financial institutions are growing, are large, are operating, as I say, transnationally, as you stress, but we have difficulties not only to supervise, but to monitor what is going on. Regarding stablecoin, I think we need to do just a meeting only for this, because at the Advisory Scientific Committee at the ESRB, we are now working, we have a task force, I'm working on this, and I can spend hours. But the only thing is that if you read in the document that I produce, in the mapping that I have about the financial system, there is also the stable coin. So they are exactly in the money market framework. So, they are really going to create maybe a lot of problem in controlling eventually the short-term rate. So this is the only thing that I'm going to add. And, are we so bad about the capital market? Well, maybe not, but, clearly there is a lot of other things that can be done. And I perfectly subscribe the idea that we need to talk about the individual one. But, it has been asked to me to talk about non-bank financial institutions. In general, if I will focus only on one, then people will start to tell me, yeah, but what about insurance? What about this? But it's true that we need to go to the micro level and distinguish them. But having also a big picture is also helping, because they are also interrelated one with the other. And having an idea of how large they are, for me, this work of looking to the aggregate data, it was very useful.
Nicola, 1 minute, please.
No, I just want to make a general statement. I don't think I want to answer to the specific of the question, but maybe in a way, touching on the very last comment that, maybe I was sort of portraying a sort of a negative picture of this evolution, and I want to make clear that that's not the case. There are a lot of positives associated with these developments. And again, this set of institutions foster capital markets, and they definitely, most of the times, there are going to be net positives for society of having, this type of developments. But at the end of the day, we're talking about intermediation activity, and again, we should be drawing also, our inference from the past, the history. Yeah.
Thank you very much, Nicola. I will finalize quoting George Orwell in Animal Farms, that because we have talked about ducks, about elephants, all the animals are equal, but some animals are more equal than others. So I think that here, perhaps, in this mixed bag, we have some animals that are
very similar.
Very similar. So thank you very much, and
thank you very much.
It has been a pleasure.
Thank you very much.
Thank you so much, Luis.
So let's move to a kind of different issue. So let me say good morning, everyone, again. This is the fourth session of this meeting, and is dedicated to the new industrial developments and the evolving architecture of international trade. We will be introduced to this fascinating topic by Ana Maria Santecreu. She will present her paper with several other authors. The paper is called Recent Evolution in the Global Trade System from Integration to Strategic Realignment. Ana Maria is an economic policy advisor in the research division of Federal Reserve Bank of St. Louis. The paper will be discussed by Diego Comín. Diego is professor of economics at the Dortmund College. So geopolitical transformation, the aggression and intention, the aggression of Russia on Ukraine, the conflict in the Middle East, and more recently, the changes in trade policy in the US, have put trade at the center stage in the discussion of many central banks, which used not to be the case. And the ECB is, and more precisely the Eurosystem, is not an exception. For quite some time, we have been reflecting on the transformation of trade pattern and on its implication for central banks. One outcome of this research effort that we have been doing at the ECB is an important report that we published last year, more or less on the same topic. And I'm glad to see that the result of our research are confirmed or speaks the same language as the paper that Ana Maria is going to present. But I don't want to spoil the presentation, so without further ado, please, Ana Maria, the floor is yours. You have 20 minutes, please.
Thank you. Thank you very much. It's a pleasure to be here. The paper I'm going to present is joint work with Florencia Iraudo, with François Essoir, who is in the audience, and with Alexandre Gaillard. Before I start the presentation, the usual disclaimer applies. The views of this talk are my own and do not represent the views of the St. Louis Fed, the Board of Governors, or the system.
So in this paper, we're going to document recent changes in the global trade system and their implications for the euro area. And as you will see, many of our findings are going to resonate with some of the discussions that we had yesterday and with the ECB's updated strategy. So let me start. Over the past decades, we see that global trade integration was mainly driven by efficiency. Countries have been sourcing imports from those countries that could produce them more competitively, either through lower costs, through higher productivity, or because they had access to key strategic materials. But more recently, geopolitical tensions and strategic rivalry has moved the focus towards resilience. Governments are now resorting to policies like diversification or reshoring to reduce strategic dependencies. And these changes are particularly important for high technology sectors, for which the risks of relying heavily on a few suppliers are significant. So what we're going to do here is we're going to do an empirical analysis to document how trade flows are going to respond to these pressures and to identify what are the risks for the euro area. Let me start by walking through the main key takeaways from our analysis. And as you will see, at the heart of many of these changes are major developments that are happening in China. So our first finding is a rise in competition from China. China has been moving from being a low-cost supplier to being an innovation-driven competitor in key strategic sectors. Second, we find selective fragmentation. We do see that the trade flows are responding to geopolitical tensions, but this response is uneven both across countries and across sectors. And as you will see, China plays a unique role in this selective fragmentation. In the case of the euro area, for example, the euro area has been reducing dependencies from Russia, but it has been increasing dependencies from China in key technology sectors. And the third finding that we see is that there's concentrated supply chains. Europe is relying on a handful of countries for the supply of key technologies and critical minerals. And many of these countries are geopolitically distant countries. So in this landscape, there's a role for coordinated policy, both internally by deepening the internal market integration to increase resilience and foster innovation, and externally by recalibrating trade policy in an environment where there's increasing global fragmentation. So let me start with our first finding. China has become a direct competitor to the euro area, both in innovative activity and in exports. To see that, we're gonna look at a new index that is gonna measure the overlap in the sectoral composition of innovation and exports, both in the euro area and in China. We're gonna look at data on patenting activity and data on traditional trade flows to document this finding. What we're gonna do in the figure on the left is we're gonna look at the evolution of this overlap. A value of 0 in this index tells us that China and the euro area are specializing in completely different sectors. And a value of 100 means that they're innovating and they are exporting in the same sectors. What we see is that these trends are going up. That means that China is exporting, that's what we have in this black line, in the same sectors in which the euro area is exporting. And what we see in the red line is that China is innovating in the same sectors in which the euro area is innovating. And what we find in our analysis is that this is not driven by the euro area changing its focus. This is driven by China starting to specialize in those sectors in which the European Union had a comparative advantage. Now, in the graph on the right, what we see is what are the sectors that have contributed the most to this convergence. And what we see is that both in innovating activity and in exports, these are machinery and transportation equipment and chemicals. These are sectors in which the euro area had a competitive edge. Okay, next, let me walk you through one of our main indicators. This is a new measure that we have developed. This is what we call the Partner Similarity Index. It measures the overlap between an exporter's sectoral specialization and an importer's sectoral demand. So what we see in the bars on the left is the similarity index between what China exports to the world and what the euro area imports from the world. The fact that these bars are going up is telling us that China is starting to export in those sectors that the euro area has been demanding from the world. So China is moving up the value chain and is starting to specialize in high-value sectors. What we see in the bars on the right is something different. This is the similarity between what the euro area is exporting to the world and what China is importing from the world. These bars are going down. What that means is that China is starting to import less in those sectors in which the euro area has been exporting to the world. And this is mainly driven by transportation equipment. This is telling us that China is starting to specialize in those sectors that the euro area was exporting. So what this shows us is that there is an asymmetric and growing trade alignment between China and the US. While China is positioning itself to export in sectors in which that the euro area is demanding, is starting to meet the demands of the euro area, is also starting to import less in sectors that the euro area was traditionally exporting. Okay. So these asymmetries are telling us that now China is getting access to the euro area, where the euro area is losing access to the Chinese market. And these asymmetries are not just theoretical. Between 2004 and 2024, the trade deficit of the euro area with respect to China increased by a factor of 3. So the main message from this figure is that trade is not vanishing. Trade is becoming more uneven and is becoming more asymmetric. And this is what we call selective fragmentation. And this is what I'm going to show you, next. So the next question that we ask is, are trade flows responding to geopolitical tensions? And how have those responses changed over time? To answer the question, we're going to use a well-established gravity method that is going to allow us to estimate the association between trade flows and geopolitical distance. So here what I'm going to show you is how trade flows are reacting to geopolitical tensions over time. Each of the dots that you're going to see in these two graphs represent the estimated effect of geopolitical distance on trade flows. A negative value implies that trade flows decrease between geopolitically distant countries. And the bars around these dots are telling us how precise these estimates are. What we're going to see in the left figure is that when we include all the countries in the world, the effect of geopolitical tensions on trade flows have been moderate, but they have become more important in the last two periods. So there is geopolitical tension that is impacting trade flows that have become more important more recently. Now, what is really new and is really striking is what happens when we remove China from this analysis. That's what we have in the figure on the right. In this case, what we see is that the effect of geopolitical distance on trade flows has been stronger than when we have all the countries, and it has started earlier. So this shows us that China still plays a central role in supply chains, and in fact, it has expanded exports across many countries, regardless of their geopolitical alignment. That's what we see happening with the euro area. The euro area is relying more on imports that are coming from China. So this is what we're calling selective fragmentation. There are studies out there, the IMF has some studies where they also find this geopolitical effect, this effect of geopolitical tensions on trade flows. What is really new here is that we're looking at how this is evolving over time, and we're really looking at this effect of China and the effect on selective fragmentation. So now let me zoom in into this idea, and let me compare how the euro area is reacting to these geopolitical tensions and how it compares with the US. So to do that, we're going to compute changes in import sources, both for the euro area and for the US. So we're going to look at what are the countries that are gaining and losing access to these two countries. We're going to plot here the top gains and the top 3 gains and the top 3 losses. So let's focus on the panels on the left. On the top row, you're going to see the effects of the euro area, and in the bottom panel, we're going to see the US. What we see here is that both the euro area and the US are reducing their dependence from China, but their strategy towards, from Russia, but the strategy towards towards China, it's being different, and that's what we see in these red bars. So while the US is decoupling from China, is decreasing its reliance in imports from China, what we see is that the euro area is starting to import more from China. Now, what you see in the middle panel and in the right panel is the sectoral decomposition. In the middle panel, you have changes in import shares for the euro area in high technology sectors. There are big differences between the US and the euro area. The US is decoupling from China in high-tech sectors. The euro area, as you would see in the red bar, is really increasing its reliance from China in these key technology sectors. What you see in the right panel is what's happening with low technology sectors. In this case, both the euro area and the US are decreasing their reliance in imports from China. So fragmentation is happening, but it's asymmetric both across countries and across sectors. The euro area is starting to depend more on China for imports of high technology sectors. So the question now is how diversify our supply chains in the euro area, especially supply chains in these key technology sectors. So that's what we're going to do next. To do that, we're going to compute how concentrated are the imports of advanced technology products, both in the euro area and in the US, for comparison. So here, we're going to compute standard measures of concentration. This is a Herfindahl index. Values above 0.25 are indicating that these countries are importing these key technology products from just a handful of source countries. Each dot in the graph is a technology product. Higher values indicate higher concentration. What we see here when we compare the euro area in the horizontal axis with the United States in the vertical axis is that the numbers are different, but the message is very similar. Both the euro area and the US are the imports of key technology products are heavily concentrated in a handful of countries. And this creates vulnerabilities to supply disruptions and geopolitical risks. If one or two countries face disruptions because there's a shock, because there's a policy action, or because there are geopolitical tensions, that's going to reduce access to key products that the euro area needs to produce. So that brings us to policy. If the euro area cannot reduce external dependencies, especially in those inputs that the euro area cannot produce, then the focus has to change towards what it can control, and that's deepening the internal market integration. Now, this idea of deepening the internal market integration is not a new one. It has been in the policy agenda for many years. But we think that it's important to bring it back, especially given all these trends that we have documented. So let me clarify why we think this is important. These trends that we have documented on the rise of China are creating a dual challenge for the euro area. First, there's a substitution risk, because China now is competing directly in high technology sectors, which can displace European firms through scale and through price. Second, there is what we call a complementarity risk, because China now is dominating on the supply of critical inputs that are difficult to substitute, and it's very difficult to scale up the production of these goods as well. And these risks are interconnected. If there's disruption in the upstream critical minerals, at the same time in which China is increasing the production of ready-to-use substitutes, that could displace foreign production, and the same time in which China could increase its own market share. So that brings us to the importance of deepening the internal market integration. By deepening the internal market integration, we can create scale. Having a more unified goods market is going to create scale to increase production and to increase innovation. This is the idea that size matters. This is the home market effect that was introduced by Paul Krugman in the case of trade, and that was adapted by Philippe Aghion for innovation. But second, having a more integrated capital markets is going to help channel funds towards high risk and high value projects. We were talking yesterday about how all these startups are going to the US to find venture capital. Having a more integrated capital markets is going to allow for capital to be better allocated and incentivize innovation. This is where the US has a competitive edge. The US has a large internal market, and it has an integrated capital market that can help reduce vulnerabilities to this type of disruptions. And we know how this has played out in practice. There is a recent paper by Laura Alfaro and co-authors where they find that China's export controls that were introduced in 2010 for exports of rare earth metals, those export controls foster innovation in foreign countries, both by creating scale and by having a more unified capital market. When the markets are fragmented, these type of responses are difficult to achieve. So that's why deepening the internal market integration can create both scale and innovation. However, as I'm going to show you next, integration has stalled since the mid-2010s. So what we're going to do is we're going to, again, use gravity methods to estimate the evolution of internal barriers within the euro area, and we're going to compare those with external barriers. What we're going to see when you look at the light blue line, and we're going to measure this in tariff equivalent units to its comparison. The light blue line gives us good news. There's been a reduction in internal barriers over time. These barriers are lower than the external barriers. That's what we see in the red line. The bad news is that this integration has stalled since the mid-2010s. So this is reflecting frictions like regulatory divergence, infrastructure gaps, non-harmonized standards. Okay? So there's been this stalling in internal market integration. So let me talk about what are the implications for monetary policy of these findings. So first, there's inflation pressures, because depending heavily on just a few suppliers make countries more vulnerable to persistent supply shocks, which introduces more volatility in inflation. This will resonate with the ECB's updated strategy that was announced a few days ago. Global supply chains were optimized for efficiency, not for resilience, and now this model is being tested. Policies that increase resilience via diversification or via reshoring can create a stability, but it also introduces costs. So it's not like the inflation output trade-off is changing. It's becoming more complex because there are changes in the underlying structure of production and of trade that are making this type of response more difficult, are making the transmission of monetary policy more difficult because there are more uncertainties being created. The second challenge for monetary policy is the euro area heterogeneity. We find that not all member states face this type of dependencies to the same extent. So that's making the calibration of monetary policy more difficult. One interest rate doesn't fit all, and we were talking about this yesterday. And that's where deepening the internal market integration and deepening capital markets can help to increase scale and to increase innovation. So let me finish with 3 key messages from our analysis. The first one is China is not just catching up to the euro area. It's actually converging. It's becoming a direct competitor in key strategic goods. And not only that, China is increasing self-sufficiency in those sectors in which the euro area used to export to China. So we have an increase in asymmetries in trade alignment between these two countries. Second, there's selective fragmentation. Fragmentation is happening, but it's uneven across countries and across sectors. And despite geopolitical tensions, China still remains central to global trade. And third, there's strategic dependencies. Europe is relying on a few and often geopolitically distant countries for the supply of key technologies. So these trends are creating risks for growth, for inflation, and for the transmission of monetary policy. And the path forward is not new. Deepening the single market can help Europe use its size to create more output and more innovation. Thank you very much.
Thank you, Anna Maria. So, Diego, please, 10 minutes.
Thank you very much for inviting me to discuss this excellent paper by Anna Maria and co-authors. So this is an extremely rich paper. It has lots and lots of facts about a diverse set of topics. It's very kaleidoscopic. If you move them around in one way or the other, you get a different picture. And so my approach to understand the paper was to make my own summary about what happened. Okay? So in a one-sentence summary for what this paper is about is the following. I think this paper tries to explore the implications of China's emergence as a technological leader on industrial and distortionary policies that have caused fragmentation. And then it tries to explore, to a lesser extent, what are the challenges of operating monetary policy, especially in that new context, are. Okay? So here is my potential summary of the findings of this paper, my potential story about all these facts. First, there's been this increased competition from China in high-tech sectors, which happen to be the sectors where the European Union, in particular Germany, was a historical leader. Parentheses, that's not surprising, okay? That's a consequence of structural transformations. Economies change the sectors in which they operate. Naturally, as they become richer, China has become richer, so it has changed the sectors. And two, the fact that innovation follows structural transformation. So you tend to innovate in those sectors where you have larger share of economic activity. I have a recent paper with Daniel Ascari from the New York Fed and Martin Mestieri that does that. Okay, so that's first point. Second point, this increased competition, this increased threat from China, together with geopolitical tensions, like Russia's invasion of Ukraine, has triggered a policy response. And the policy response has been huge. This is one of the things that Anna Maria didn't show in her discussion, but it's occupies a significant space in the paper. It's massive. There is a huge number of new policies that have emerged as a consequence of these two forces, potentially as a consequence of those, and that has led to fragmentation, which may have implications for inflation, output, and policy making. Okay, so in my presentation, I would like to talk about three things. First, I would like to briefly mention this evidence on increased competition from China, and I would like to discuss a bit the relevance for growth. Second, I would like to think a little bit about what are the potential drivers of the policies that have caused the fragmentation. What is the rationale for these policies? And third, I would like to think a little bit more about the consequences of fragmentation for inflation. Okay, so what are the facts, the main facts? Well, first, China has increased the share of patents in the world. Okay, so patents in China has increased dramatically. Interestingly, the sectors where China has patented have overlapped more and more with the sectors where Europe used to patent. Similarly, for trade, China has been changing the composition of trade towards sectors where the rest of the world imports more, like auto, machinery, and transport equipment. And Europe has been exporting more in sectors where China imports less. Okay, so the Chinese are less interested in the stuff that Europe exports, and Europe and the US are more interested in sectors that China exports. Okay, now a couple of potential criticisms about the methodologies. First, innovation here is measured by patents. This is a cheap shot, but patents are not a great measure of innovation. They don't measure the quality of the innovation. Many innovations are not patented, so that doesn't apply uniquely to this paper. It applies to a whole industry. Second, this paper tries to measure the overlap both in innovation and in exports by looking at two-digit sectors. That's too aggregated. Okay, like you would like to go thinner than that. The authors have the data. They cannot show it, but I would like to see it. I'm sure that the fact will stand. Okay, so I'm not surprised about the fact. Okay. A bigger issue is, should we care about that? Is this important? Like, is this a big problem or not at all? I tend to disagree with the tone that Ana Maria used in her presentation. The tone didn't transcend the paper. The innovation is not a zero-sum game, okay? We know that. We know that innovations are non-rival, so if somebody else invents something, I don't have to invent it again. Knowledge spillovers, you cannot encapsulate them. So if the Chinese invent something, we learn all something about those technologies, and that's going to be good for everybody else. We shouldn't be upset about the fact that China is inventing stuff, okay? That's good for all of us. So what about productivity growth? Well, innovation, it's important to understand productivity growth at the aggregate in the world, but it's not important to understand productivity growth for individual firms. Most firms don't innovate at all. In high-income country, only 20% of firms do any innovation. Much more important than innovation is the adoption of technologies. And recent work with Xavi Sirera and Marcio Cruz, what we have seen is that in most firms, there is a big gap between the best technologies they have adopted and the technologies that they end up using. This gap between adoption and use of technologies explains a huge variation, a huge amount of the variation in productivity across establishments. So that's a margin that we should focus if we want to improve productivity at the establishment level, at the firm level, okay? Okay, so maybe this is not just about productivity or growth, maybe this is about jobs, okay? And I will talk a bit more about that. It's unclear to me what tariffs or barriers to the import of high-tech Chinese products is going to do for jobs on net. On the one hand, it's going to protect certain industries like solar panels. You know, now we have, you know, German solar panels. There will be workers there that will work. But on the other, there will be many sectors that would use cheaper Chinese tech products that would grow more, they would invest more, and there would be more jobs created there. So on net, I don't know what's the result, but it doesn't strike to me as a clear, as a very easy question and as an obvious question. Okay. Furthermore, as we have seen, protecting high-tech sectors in the EU or in the US has higher level trade-offs, okay? Presents higher level trade-offs, like, you know, both in the EU and in the US, when protecting solar panel industries and EV industries, we compromise the green agenda, okay? Because it was much more expensive now to have like green cars, like we have benefited a lot from having cheap Chinese electric vehicles and cheap Chinese solar panels to push the green agenda. Instead, we chose to protect our local industries at the expense of the green agenda. Okay, so, on the distortive, I'm doing so bad in terms of time. Okay, so on the distortive policies, there is many of them are local, others are global. They are very distinct in terms of nature. It's not obvious to me, like, what's the dominant force that drives them, okay? As I mentioned before, you know, if you look at the geopolitics, bilateral trade flows have been increasing throughout, both within blocks and across blocks, according to the authors. And only in the last couple of years, you see a slow decrease in bilateral trade flows across blocks, okay? So that's where the geopolitical tensions emerge. If you think about what other factors may have driven trade distortions, as I mentioned just a second ago, like, you know, I don't think that welfare enhancing, the nature of these distortions is motivated by welfare enhancing policies because of innovation or because of productivity. A potential argument to be made is that this is maybe driven due to welfare enhancing policies that are to protect medium skill jobs. In my view, that's not, that argument presents a fallacy, which is that in the big scheme of things, the role of trade in medium-skilled jobs is not measured, okay? Most of the medium-skilled jobs that have been lost are not in tradable sectors. They are in non-tradable sectors. And even in tradable sectors, if you look at the reduction in the share of manufacturing, for example, in the US, in terms of value added, has been much smaller than in terms of employment, okay? Which means that much of the jobs have been lost to automation, not to trade. And furthermore, a more important driver an important driver of this reduction in jobs and value added in medium skilled sectors are income, okay? Because as we become richer, we tend to buy more high income elastic sectors that are more skill intensive, okay? So at the end of the day, trade probably comes at the bottom, and yet the narrative is that jobs are destroyed only through trade, okay? That's probably not our narrative in academia, but it's the narrative in politics. And so it's very easy to shoot at this particular culprit in terms of trade. If I have 1 more minute, I will talk briefly about monetary policy. Basically, the point I want to make about monetary policy is instead of commenting on the interesting points about geopolitics and supply chain disruptions, the point I want to make is that the consequences of the unraveling of the global trade for inflation depend a lot on how this unraveling takes place. If you think of it as a one-time shock, where a fragmentation emerges, surprisingly, that's going to increase the cost of production, that's going to shift the Phillips curve, that's going to cause inflation, okay? However, that's not how fragmentation takes place. Typically, the way it takes place is fragmentation is something anticipated, okay? Either because it plays out in the future and we gradually get there, as Ana Maria showed, or because there's lots of uncertainty, as we have seen in the US, and eventually we may have more fragmentation, but we still don't know when or how, okay? And so as a result, what that means is that the main force is not going to be this shift in the Phillips curve, but there's going to be a shift, an income effect, a wealth effect, that is going to shift the IS curve. It's going to affect the real rate, which yesterday was, undermined. And that is going to cause deflation, not inflation, okay? So in my view, a big reason why we are not seeing inflation, even though we have all these potential tariffs playing out in the US, is the fact that it's affecting the real rate. And as a result, people are not consuming so much, and we are, aggregate demand is going down. And that's something that I think we are seeing in the US. Certainly we are seeing it in Europe or in Japan or Korea, okay? I would like to leave here. Thank you.
Thank you. Thank you, Diego. So, Ana Maria.
Yes.
Back to you to answer to these several questions.
Thank you, Diego, for a thoughtful discussion. I just wanted to make 3 points in response. First, on the use of patents, we totally agree that patents are not a perfect measure of innovation, and definitely they are not a good measure of innovation quality. However, the way in which we use patenting in this paper is a little bit different. For us, the fact that China is now starting to file patent applications in these high technology sectors basically tell us that China is positioning itself either because China is growing and there's transformation, or because of industrial policy that is happening in China. China is starting to target these sectors and is starting to become a direct competitor in these sectors, both in innovation, but also, as we show in our paper, on export activity. So we're using patenting in a more general way, right? So China wants to put itself to become a direct competitor in this type of sectors. We totally agree, two-digit level of aggregation is very aggregated. We're actually working on refining and doing this analysis at a more granular level. My second point to the question of should we care about it, should we care that now China is becoming so efficient at producing this type of goods and innovating in this type of sectors, we agree that innovation is not a zero-sum game. Global knowledge is good. There's knowledge diffusion, and countries can benefit from this knowledge diffusion, and they can grow. But the problem now is, going back to how I started the presentation, now there is a trade-off between efficiency and resilience. And the problem now is that we are sourcing these inputs from countries that are geopolitically distant. There's geopolitical risk, and disruptions can really impact negatively production in the euro area. So we have this trade-off between efficiency and resilience that we care about. My third point is on jobs. We agree, but I think that that's more relevant for the first China shock, where we saw that China was competing in low cost. in sectors that were labor intensive. The second China shock is a little bit different. Now China is competing in high technology sectors. So if maybe there's a job displacement there. I think the problem now is on displacing production in this type of sectors.
All right. So,
can I reply?
Please.
So, thanks, Ana Maria. I mean, I think those are great points. On the resilience, I mean, I benefit my research from studying supply chain disruptions, so I'm a big fan of them, but I don't see them everywhere, okay? And if you go back to what happened during COVID, that had nothing to do with geopolitical risks, okay? That had to do first with a reduction in capacity to produce in 2020, and then in 2021, 22, 23, it had to do a lot with a huge demand, to a large extent fostered by European and American central banks, and that was why supply chain disruptions, took an effect on inflation. So, should we be now more worried about China than when we were like 10 years ago? Has China changed so much in the last 10 years? I don't see that this geopolitical risk, like in terms of alignment in UN votes, or I don't see why this should be a big problem now vis-a-vis 10 years ago. Personally, I understand that there is a risk, but I don't see that there's been that much developments on that. And with respect to jobs, the paper is fantastic, okay? But unfortunately, many things have changed in the last 5 months. And I say unfortunately because the paper in a way cannot capture them, but also because it's unfortunate the turn of events that we're seeing in the US in terms of these barriers. And clearly the main motivation, one of the key motivations that the Trump administration has for barriers has to do with jobs. I want to return jobs to the Midwest. So clearly that's salient in the narratives at least.
All right. I have already 7 people asking for the floor, actually 8 now, so I invite everyone to be short and sharp in the questions. So the gentleman. No, okay. Then I have Jean-Pierre and then the lady in the front.
Volker Wieland, Goethe University. You mentioned or pointed out that China and Europe have become more similar in imports and exports, particularly in manufacturing, automobiles, chemicals. These are, as you mentioned, Diego, areas where Germany has an outsized presence in Europe. And I think there's an important driving factor you didn't look at. This driving factor is really the companies who produce these. So if you look at German companies, they are heavily, both all the large companies in these areas, but also all the medium-sized companies, they heavily produce in Germany and in China and other Asian countries. So a lot of these imports and exports and becoming more similar over the last 20 years is driven by that process. These companies are producing in both places. To give you some examples, if you want to produce a bottling manufacturing line, these are real-life examples I know about. Well, you don't just want to produce that in Germany and export it to the rest of the world. We're 80 million people. You have in China already 1 billion, in Southeast Asia more than 500 million. So you're going to have to produce it elsewhere too. And ideally, you can get high value-added elements, often service-related services in Germany, which are related to the manufacturing of these things. And that's part of the wealth creation in Germany. So it wouldn't be possible without this globalization, and it's driving this. If you go to the China Development Forum, all the top CEOs of the big German companies are there precisely for that reason. And of course, now they're not only producing within China and sending back parts in both directions, they're also supplying Asian markets, so it would show up in the exports. I'm much more worried not about this trend, but about, for example, seeing Volkswagen losing out in China, where it's producing on the Chinese costs, getting Chinese subsidies, but losing out to Chinese producers of electric vehicles. I think that's the worrisome thing.
Jean-Pierre.
Pierre-Olivier Goracha from the IMF. So I think this is a very interesting paper, and I wanted to make a couple observations. So first, the increased dependency of the EU on China, I think, is very well noted. But there is also another dependency for the EU, that's on the export side that is also in the charts that you were showing. And that's maybe in part a result of the macro forces. It's a dependency, increased dependency on the US. So what we're seeing is an increased share of US imports coming from the EU at the same time as the EU has an increased share of imports coming from China. So in the work we've done at the fund on how trade flows are restructuring given increasing trade tensions, there are two stories basically. There is the emergence of what we call the connector countries along the supply chain. So these are the Vietnams and the Mexicos of the world. They're intermediated production from China to the US. But there are also what we call macro connectors. So just the fact that these trade tensions are not changing the overall trade balances, or maybe changing only the bilateral ones. So that means the flows are coming from somewhere else, maybe not along the supply chain, but that dependency is there as well. I think that's important for the EU. Second, I share some of the points made by Diego on, we have to be careful when we are talking about dependencies. To me, what was striking last year, the CPR and Bruegel published a Paris report that was looking at this question. There was a chapter by Isabelle Méjean on trying to identify critical inputs for the EU. And their appendix in their paper has a list of the identified goods there. And if you look at that list, it starts with castor oil, and then you have things like electric blankets, camping goods, you have, air dressing appliances. Clearly, these are not things I think we think of as critical dependencies. So, and this is done with the sort of state-of-the-art technology, which are the goods that we, very concentrated suppliers, very low elasticities. You apply sort of very reasonable criteria, and you end up with an largely nonsensical list. I don't think we would want to put trade restrictions or think that we have to develop castor oil supply somehow. So I think there we have to really be very careful about what we identify as critical inputs, because that's an open door for forms of protectionism that I think we want to resist. Then the last point I want to make is on innovation. Again, echoing some of what Diego said, I think we have to apply sound trade policy principles. There's nothing wrong with another country innovating, even if it's innovating in industries that we have a comparative advantage in. It's only a problem if somehow they're putting in place trade distorting policies. And so the question becomes, how distorting are their policies? There is a good case to be made that in the case of China, there are all kinds of policies, but that's where the attention should be, and that's where the remedies should be going. Thanks.
Okay.
Thank you. Nicola Fuchs-Schündel, WZB Berlin Social Science Center. So thanks a lot for the interesting paper and discussion. I have two questions for Anna Maria. So you are stressing that increasing resilience through reshoring will increase costs and inflationary pressure, and that the way out is a deepening of the single market. So to question, what do you think is the most important measure for deepening the single market? And secondly, couldn't we even rephrase it as chance, because you show that the trade barriers within the EU are still very high. The numbers are actually kind of shocking. So could it be that this kickstarts a deeper single market that could actually lower costs despite the reshoring that we do away from China?
All right, let's try to get first answer to this first section, and then we move to the next one. Please be short, because we have many people that wants to get in.
I'll try to be short. Thank you for all the questions. We agree with many of the comments that you have been making. First of all, we are not advocating for introducing trade restrictions in the paper. We're just like laying out where the main vulnerabilities that the euro area now is facing. On multinational production, it's true that many European firms, especially German firms, are moving both to the US and to China to produce there. But we do see that China is starting to specialize in these sectors in which the euro area has a competitive edge, either because of industrial policy or production subsidies. So we do see that a lot of these exports that are coming from China, whereas we are losing access to the Chinese market, are coming from that. Now, on Pierre-Olivier's point, it's true that not all concentration on products, not all products have the same risks. We are aware of Isabel's work, but here we're showing that these dependencies are coming on critical inputs. So for example, we saw high levels of concentration on sectors like solar panels, ADP machines. These are sectors that are key for the digital and green transition. So these are sectors that the euro area cares about. Then on the question on resilience and what is the most important area for deepening internal market integration, here we push a lot for having integrated capital markets, because that's going to make the allocation of capital better. That's going to channel funds towards startups that now are going to the US to look for venture capital, and that potentially can create innovation. So that's what we are basically emphasizing in the paper. Now, if I may make another remark to Diego's point on the COVID, it's true that during the COVID pandemic, the problem was not just supply chain disruptions. It was the fact there was a huge demand shock at a moment in which there was binding capacity constraints, and that's what created inflation, and that's what you have shown in your paper with your co-authors. The world is a bit different now, and here I think that the risks are facing persistent supply shocks that may come through disruptions.
All right, let me move to the right, Helen, and then the lady down there.
Thank you very much. Ellen Ray, London Business School and CEPR. So while I agree fully with Pierre-Olivier that we should not worry about castor oil and the electrical blanket, however, I think I would like to put a little bit of a spotlight on the global commodity markets, and so the impact of China there. Well, we are seeing some differential importance now of different commodities. We are moving a little bit out of fossil fuels, and we are going into electrification, which I think we'll all agree is very important for the future of energy security in Europe. And if you look at all the materials which are listed actually by the IMF as key for the electrification process, and you look at the centrality of network and the centrality of China in these networks, you will see that in the last 15 years or so, the centrality of China has become extremely important, and that does look like a strategy. So much so that these networks, unlike the fuel network, which are more distributed, they look a lot more now like a hub and spoke, with China in the middle as a key processing node. So I think, from the point of view of Europe, this is definitely something that maybe we should focus on a bit.
Yes.
Beata Jaworczyk from the EBRD in Oxford. I think that from the policy perspective, it's useful to separate the competitiveness challenge from the reliance on imported inputs. Yes, deeper integration of the single market is good in its own right. It's going to help with competitiveness, but it may not help with the access to some of the critical raw materials. Think about rare earth. 10% of known reserves of rare earth are in Western countries or countries aligned with the Western Bloc. And some of you may recall that we talked about this last year in this room. So in this case, this deepening of the single market will not do the trick, right? What about other inputs? I think if you believe that the EU is less exposed to shocks and disruptions than other places, then reshoring makes sense. If we are more or equally exposed as other places, then we would want to diversify. Right? The problem is if production sources, like in the case of solar panels, are concentrated, then you want to stockpile. And I think in many cases, stockpiling may be an answer. Thank you.
Okay. Why don't you answer to these two, and then we move to the left and we close, please.
Yeah, no, I completely agree with both Hélène and Beata's point. On a land, that's true, the centrality of China, and this is something that we see with other critical minerals, has increased substantially. We are not looking at the global commodity markets. We do look at rare earths, and as Beata was saying, we do see that China is dominating the processing and the extraction of these rare earth metals. This is, and we actually have something on that in the paper. We see that the euro area is relying on these rare earth metals that are coming from China, and the concentrations are quite high. And this goes back to this paper that I was mentioning during my presentation, the paper by Laura Alfaro, where they show that these export controls that were introduced by China actually foster innovation in other countries, both by increasing size and by deepening market integration.
So I have nothing to say about rare earth, but we have to be serious about which side we are. Like, are we for the green agenda or are we for protection of special interests, okay? We cannot argue that we want to push the green agenda at the same time, like, put tariffs on Chinese solar panels and electric vehicles because they are too cheap for us. So we have to, if we are going to push for the green agenda, then, we have to put that ahead of the special interest and accept the gifts of China in terms of, like, cheap electric cars and cheap solar panels, because that's going to be great for us, and get our house together and get our, like, charging ports in place and integrate, like, those markets, that's going to foster the diffusion. But we cannot, like, go on both sides. Like, we cannot complain about China and then push for the green agenda. There is a clear trade-off. We have to take one side.
Great. So next, Yanis and Oscar. Please, Yanis.
Thank you for the thought-provoking paper. I think one of the strongest laws in economics the last 100 years is the law of comparative advantage. And if I'm correct, it is still valid with all the modifications. So we have to be extremely careful when we say that a country like China is emerging, is innovative. This is not a reason to have trade restrictions. I mean, humanity has benefited from liberal trade in the last 100 years. So if we want to impose tariffs, we must have a very serious reason. Up to now, I haven't heard of any serious reason. I mean, that China is innovative is not a problem. I mean, okay, if we have in mind strategic arguments, this is another story. But if we're based on trade theory and trade practice, we have to be extremely careful. By the way, you have portrayed Europe as being in the middle between the two mythical monsters, Scylla and Charybdis. On the one hand, we have tariffs for the United States. On the other hand, you have the strategies of China. So perhaps you give a way out in the second part of your lecture when you showed that the intra-Europe constraints are equivalent to a tariffs of the order of 70%. So by eliminating these tariffs, we liberalized trade within Europe. So also that gives an answer to the first lecture that we had, why non-banks are investing abroad. They are investing abroad because the rate of return of investment in Europe is rather low because of the constraints you have portrayed and because we don't have enough liquidity, we don't have enough safe assets in Europe. So I prefer the second part of your lecture as more constructive rather than the first one, which contradicts the predicaments of free trade. Thank you.
Oscar, and then, I'm sorry, I have to close too many. I'm sorry, Oscar, and then we are running out of time.
Thank you very much for the very nice paper and the discussion. So one of your key recommendations, Ana Maria, was that Europe should foster investment. We should invest more and better. I would agree with that. But I guess the key natural following question is what kind of investment, what kind of a strategy should we follow? And I think you can distinguish here two kind of clear different models or strategies. One possibility is that we keep investing to maintain our export orientation. And the question here is whether do we want to become more like China? Or else the alternative is to foster more domestic final demand. That is, do we want to become more like the US? I guess this is a key question, and depending on the answer you provide to this question, this will have profound implications for some of the debates that we have had. No? This is certainly crucial for the previous discussion on the financial sector, the capital markets union, and so on. As Victor Constancio rightly said, if we insist on an economy that is oriented towards exports, we will always be a net lender, and no matter how well we do in the financial sector, we will always keep exporting capital to the rest of the world, and probably to the US, most of it. I think it's important to make this discussion at this point, especially because one of your key takeaways is that we are becoming more and more reliant and vulnerable to supplies of critical materials and all these things. This is certainly the case with energy, but the main vulnerability, the main dependency for me is external demand. We are still so much dependent on external demand that this is probably should be the key focus of vulnerabilities. Thank you.
So I don't think, I mean, please, if you want to comment, but those were more comments than...
1 minute.
Yeah, well, much less than so. 20
seconds. Okay. So, Yanis, to your point, I think that was the key message of our paper. The first part of the paper is saying it would be great to have efficiency. Trade is good. We're not advocating for tariffs. But we're in a different world now. We're in a world in which there's geopolitical tensions and there's geopolitical risks. So now we have another factor that we need to take into account, which is resilience. Now, what is the solution? That's the second part of our paper, as you put it correctly, is opening the internal market, reducing these tariffs that we have estimated. So these two messages are connected. Efficiency is great, but now we have geopolitical tensions. It would be great to open and take advantage of the scale that we have in the internal market. Okay.
Diego?
Nothing to say.
Okay, so finally we can close. My own conclusion is don't blame others, don't blame free trade for your problem, put in order your own house. This is my humble personal conclusion of this debate. Thank you to all for the rich discussion.
Thank you very much for getting us off to such a good start to the day. We're now going to break for coffee and see you back in here in a little bit less than half an hour to talk about central bank communication. Thanks a lot. Could I ask you all to take your seats, please, for the next session? The rapid shift from very low inflation to the most severe bout of price pressures for several decades has changed the way central banks communicate, testing transparency and credibility in a way that has not been for years. Promise-heavy communication that worked at the lower bound can backfire if the public doubts the commitment. At the same time, central banks are increasingly striving to reach not only the public, but financial markets, the traditional audience, at the same time too. This panel will draw on a range of experts from several fields, central banks, journalism, and academia, and ask what they think can be done to better get central bankers' messages across. It will be chaired by ECB Executive Board member Philip Lane. Mr. Lane, over to you.
So let me begin by noticing that the title of this panel, Central Bank Communication Current Challenges. My bet is if you go around the room, that means different things to different people. So we could have had a panel, Communication Current Challenges, because of course every organization faces a communication issue now in the world of new media, as the President was saying, yes, with deep fakes, all sorts of misinformation, disinformation. So everyone in the world can talk about communication. And then when we go to central banks, as Claire just also indicated, one element of that is communicating about the central bank as an institution. So whether that's the mandate, explain what the mandate is and is not, whether it's about explaining why uniquely, in many ways, central banks have a lot of delegated independence. There's a lot to communicate about there. But then, of course, we also have the more narrow topic of monetary policy communication. And then within monetary policy communication, one question is, whatever you've just decided, how do you communicate your current decision? But also the pros and cons of communicating about the future. So Andrew Bailey yesterday noticed that it's not always the case that a conditional statement remains conditional. There can be a filter where something that's accurate conditionally suddenly becomes an unconditional communication. But on the other hand, there are pros and cons. So we're going to cover a lot with the panel members we've assembled. And then maybe coming back also to a pretty basic issue. Central banks are public institutions, and behind everything is a default of transparency. So that's also very important in many ways. Maybe I'll also before handing over to the panel, I recall Ben Bernanke famously had this ratio. That monetary policy was 2% action, 98% talk. I'm not so sure that ratio is preserved. But maybe by the end of the panel, let's see if we have a new ratio to think about. So with that, and as Claire mentioned, I mean, it's important for this panel to come up with a range of different backgrounds. So I'm really pleased that the first presenter is Alessandra Galloni, who's editor-in-chief at Reuters, because I think the risk would have been, if there's only central bankers here or academics, how what we say gets intermediated by important intermediaries like Reuters and their competitors is so important. So Alessandra, over to you.
Thank you. I'll go. Thank you, Philip. So first of all, I have two disclaimers. The first one is I don't have a presentation and I don't have any slides, and I have very few numbers in what I'm about to say. So that makes me a little bit of an outlier today. The second one is, despite the theme of this panel, I'm afraid that I cannot give advice to central banks on how to communicate because, like you, Reuters fiercely guards its independence. That said, I can explain how we, one of the world's leading providers of financial news, work on the other side of the communication spectrum from what you're going to hear from the other panelists. And in particular, how we navigate some of the political and societal pressures that we and other news organizations increasingly face as we report and deliver the news. And two, how we are using AI to help us report, edit, and publish the news, even as many people, including President Lagarde just yesterday, expressed legitimate concerns about this technology. So we, news organizations, perhaps like central bankers, face, I think, two overriding challenges: credibility amid uncertainty and technology. For us, so from our point of view, for years now, we've had a years-long rise in misinformation, disinformation, fabrication, conspiracy theories that have created a new epoch, if you will, of epistemological uncertainty. Most of you know Reuters from our presence in boardrooms, in central banks, in corporate boardrooms. But actually, among our 2,600 journalists, we have many on the front lines of world wars. So Ukraine, Russia, Israel, Gaza, Iran, Lebanon, Sudan. And there, the temptation for propaganda is very high. And there, sifting fact from fiction is often a question of life and death. Then, in the official halls of many governments, increasingly distinguishing true from false is difficult. And in many countries, including in the United States, the media is under direct and fierce attack from political leaders. Perhaps sounds familiar. And in part due to these attacks, the public doesn't trust the media in the way that it used to. Trust in news across markets globally is pretty low at 40%. This is according to Reuters Institute, a think tank based at Oxford. So for us, transparency, and Philip mentioned it, is a big part of the solution. Our legitimacy rests on sustained confidence that we provide factual and fair information. And so, for example, this includes that we issue clarifications and corrections or retractions promptly and comprehensively. And also, it includes being honest about the inherent limitations of our reporting by disclosing in our coverage, in our stories, not only what we know, but also what we don't know. So, for example, I'll give you a couple of examples. We recently wrote a story about the U.S. Defense Secretary who ordered a halt to flights with weapons to Ukraine, but didn't tell President Trump. And this was an important article in the context of the current relationship between D.C. with Kyiv. And it relied, this article, accurately on many unnamed sources. But we didn't have all the details. And so in our story, we were very clear that we didn't, including with sentences such as, Reuters couldn't establish when the flights were ordered canceled, or Reuters couldn't determine if Hegseth or his team knew how the order would play out. Or two people familiar with the matter denied that there was a true cutoff in aid, and one described it as a logistical pause. Another example is a recent story we published, you might like this one less, about how some European central banking and supervisory officials are questioning whether they can still rely on the Fed to provide dollar funding in times of market stress. Now, the story was rock solid. It was based on 6 independent sources. But we were also clear about what was not happening. And so we included sentences like, the sources consider it unlikely that the Fed would not honor its backstops. And the Fed has never suggested that it would not stand behind its backstops. A Columbia Journalism School professor who commented on the first story that I mentioned said in a blog post, "This level of candor did not diminish the story's credibility, it strengthened it." Another way we try to build credibility with audiences is to cover the story, but not to become the story. So for us, being out of the spotlight helps us to report the news reliably. Journalists are perceived as less trustworthy if we wade into political, societal, or economic debates. And setting our opinions aside and being humble, as Governor Bailey said yesterday, about the possibility that our hypotheses may be wrong are key ingredients to maintaining trust. Our coverage and the impact, hopefully, that has on people's decisions, people's lives, should speak for itself. And again, I think there are some parallels here from some of the themes that have emerged over the past couple of days in central banks. So the second challenge is technology, and I'll spend a little bit more time talking about this. So social media platforms have for many years democratized access to news, and that's a great thing. For those of us who believe in the power of information, that's great. But they've also made it easier to propagate unverifiable and distorted views. And of course, the rise of generative AI, which can generate very high quality, increasingly realistic text, images, and other content. I mean, we sift through, I could do a whole other presentation on some of the images that we have to verify every day. So this has turbocharged this dangerous phenomenon. It's difficult to accurately measure the increase in this problematic material that is out there. NewsGuard, which is a service that evaluates news websites for reliability, says that in the last year it found 794 news and information websites in 16 languages that use unreliable AI-generated content. And Europol Innovation Lab is predicting that the vast majority of all internet content will be synthetically produced by 2026, so just in a few months. At the same time, used responsibly, AI does offer us real opportunity to improve the way that we cover news. So as you all know, we deliver news to markets through a financial terminal owned by the London Stock Exchange Group. But we also reach more than 1 billion people a day through all of our thousands of customers, news organizations around the world that are our clients, and of course via our own website. In delivering news to all these audiences, but particularly to the markets which operate in fractions of a second, we have to always balance the need to be right with the need to be fast. Now, when there's a trade-off, accuracy always wins out, of course, but generative AI is helping us to sort of square, if you will, this speed accuracy circle. And here is how. So for years, we and other news organizations have used various technologies to extract facts from corporate financial results and from central bank statements. And we publish them automatically to the terminal. Now, for an increasing number of corporate results, and soon for official communications like central bank communications, we're using an AI tool called Fact Genie. This uses an LLM to extract facts from lengthy corporate releases. We also have tools that recommend headlines for a story, and we're now experimenting first drafts of stories. Now, I want to be clear. A journalist always checks the accuracy of this content before publishing. But not only, we also disclose to our public, because again, disclosure, transparency is important, that the AI tool has been involved in the creation of the story. Fact Genie, this tool, is allowing us to publish twice as fast as before, and we've only been using it for a few months. We expect it to get even better. We also use real-time transcription and translation tools, but again, their output is never published without human validation and always with disclosures. Our central bank reporters and editors are also getting helped by the AI tools. They're experimenting with other AI tools that they run through long central bank communications, so sort of the minutes of meetings or monetary policy and financial stability reports or the beige book in the Fed's case, to help us find signals amid the noise. So for example, we used it just on the assessment of April's liquidity crunch in the treasury market. Was it more dire? We tried to measure it versus was it more dire than the early days of COVID? Or were farmers and food processors in the Kansas City Fed's district the only ones that were worried about the effect of immigration, say, on their labor pool, things like that. Soon, AI technologies will be reliable enough for the machine to suggest news headlines and stories in real time based on the spoken word. And soon, these AI tools may even be able to create news based on sentiment. UBS, and I was talking to someone from UBS last night, has built a massive database of central bank news and speeches over the past 30 years and uses an AI tool to model the shift in the tone of communication. They say that such tone shifts detected from aggregate communications is a leading indicator of market pricing and actual policy action, and they rate it on a sort of hawkish and dovish scale. But importantly, what have we learned, over the past sort of year or so of using these tools? So far, we've learned that AI is very good at condensing the main message of a long policy speech into digestible alerts. But the AI models produce a significantly larger number of news alerts than those created when a journalist handles the coverage. So the point is that AI will get to the real news faster, but it's also likely that the key news or the intent or the subtle adjustment in a 5,000 word, for example, ECB speech, could easily be missed. In fact, it most likely will be missed. So what we're doing, in addition to human intervention and disclosure that I mentioned, is we're trying to reduce the overload. So despite the higher volumes that FactGenie is recommending, FactGenie recommends a lot of things that we could put into alerts and stories. We've actually made a real effort to reduce the number of our alerts, of our headlines that we publish to the terminal. Just this year, we've reduced it by 15%. So we're trying to, if you will, we're trying to be kind of a counterbalance to the machine. We're also training FactGenie to publish alerts that are deemed highly newsworthy based on the judgment of our team. So we're trying to teach the machine news judgment. Not working so well yet, but of course, machines make mistakes. And because news cascades so quickly, errors are going to be reproduced on countless platforms. And inevitably, correcting them is going to be difficult because it's going to be a human who has to correct them. So just as an example, anytime any of your central banks do maintenance for your websites, our monitoring system picks up a flood of items thinking that they're new. A lot of these, most of these have timestamps or dates, so that helps, but it doesn't eliminate the risk entirely. We're also focusing how to use humans and technology to detect errors. That's another sort of stopgap we're trying. So again, to detect them quickly and comprehensively, because again, correcting errors is key. There's another risk. Central banks often generate considerable noise. So the ECB Council, 26 people who all speak, and AI, it's not such a bad thing for us, but anyway, AI will struggle to capture the real news when there's an abundance of competing voices, generating a great deal of output. And then, of course, there are things that AI just can't do. AI cannot have an off-the-record conversation over lunch. In the case of Reuters, it'll probably be a cheap lunch, but an interesting lunch, and gain an in-depth understanding of the topic. It can read what is published, but it will struggle with what is not published. So, and often, as you all know, it's the omission or it's the word change that gives you the nuance with the key message, or for us, the key story. And it struggles, and this is key, I know somebody else is going to talk about who gives the message. It struggles to distinguish between the relevance or among the relevance of certain voices. So it will fail to understand the significance of a more slightly of a dove, for example, making a relatively hawkish comment. And so that brings me to the end, and the greatest opportunity I think that AI is providing for us is that using AI tools responsibly for our real-time market news frees up our journalists to do that which only humans can do. And that is reporting out that distinctive, nuance, the insight, the analysis, the interviews, the source-based stories that are valuable both to a sophisticated market audience, but also to our more general, global, and very, very large audience. So to conclude, my last point, I actually asked the AI model called Claude to suggest a possible closing paragraph for me. And this is how it responded. I understand you would like a concluding paragraph for your speech, but as Reuters editor, you should understand that I cannot generate original speech content for you to deliver at the European Central Bank. This would conflict with Reuters' principle of independence and journalistic integrity that you have highlighted in your own speech. So maybe there is hope yet.
So no doubt many of the topics Alessandra raised will come back in the course of the panel. I will say a clear byproduct is, as we see all the research coming out, central bankers are getting very self-conscious because the tone of voice, how you appear, facial expression, all of these are now coded by the AI. So it's kind of, it's impossible to get up in the morning. Let me next turn to Carolyn Fleuger from the University of Chicago. One of our key audiences, of course, is the professional audience, and understanding how they learn about the reaction function is so important. And maybe, again, coming back to the Bernanke 298 ratio between talk and action, or action and talk, I should say, this is going to be revisited by Carolyn. So over to you, Carolyn.
Thank you so much for including me. I will talk about perceptions about monetary policy in 2025. This is, of course, based on joint work with my terrific co-authors. We live in interesting times for monetary policy. After the pandemic of 2020, inflation spiked in 2021 to levels not seen in 40 years. Initially, policy rates in most advanced economies remained at zero, but then over a year later, the ECB lifted off in July 2022, reaching a peak in late 2023. Since then, inflation and rates have gradually come down. A well-perceived monetary policy framework matters for at least 3 reasons. And we've just concluded, we heard about the conclusion of the framework review, right? This needs to be absorbed by the public. Well, first, it accelerates transmission through financial markets and allows markets to do the central bank's work for it. For example, if the ECB's reaction function is known, markets can react appropriately to macroeconomic news, thereby moving relevant rates even before the next policy meeting. Second, many have argued that a high perceived inflation reaction can improve the inflation output trade-off, meaning that it is possible to bring down inflation more easily and at less economic cost. And third, bond market safety and monetary policy credibility are interlinked with the broader economic and policy environment, including geopolitical safety. The core of my comments will be centered around the question, how did perceptions of the ECB's monetary policy framework change during the recent inflationary experiment and beyond? And we have 3 main findings. First, the perceived inflation reaction rose substantially between 2021 and 2023, from basically 0 to 1. This means that the Taylor principle was satisfied once the tightening cycle was underway. Second, high-frequency bond yield responses also strengthened in response to inflation surprises and have remained strong through the most recent data. This is consistent with an increase in the perceived inflation reaction and is good news for the ECB's long-term credibility in controlling inflation. Third, bond stock co-movements turned positive in late 2023, which can also be attributed to the new perceived inflation reaction when supply shocks are present. These findings have implications for monetary policy communication. Most importantly, I want you to take away that there are tools to measure the perceptions of the monetary policy framework, which is useful to evaluate whichever communication strategy you choose. Moreover, both the timing of the increase in the perceived inflation reaction and subtle differences between Europe and the US suggest that actions matter. Markets and observers perceive a higher inflation reaction after a hike in times of high inflation, or more relevant right now, are easings that are clearly dependent on incoming inflation data. Further, quantitative data, such as we use in our analyses, is useful. So central banks may want to get in on that game and publish their own data that can help communicate the framework through quantitative communication viewed most broadly. All right, so let's turn to the data. This figure shows the raw data from the ECB's survey of professional forecasters that we use to measure the perceived inflation reaction. The perceived inflation reaction here is basically the slope in this plot between inflation forecasts on the x-axis and policy rate forecasts on the y-axis. So one dot in this picture here, for example, might be the forecasts for inflation and the policy rate by one bank, let's say Société Générale, for the next year. A different dot might be different financial institution or economic consulting group with a different forecast horizon. There's a steeply upward sloping relationship here. For example, a 1.5% inflation forecast was associated with a rate forecast of 2.4%. By contrast, a 2.5% inflation forecast was associated with a much higher rate forecast of 3.6%. This is exactly what we would expect to see if professional forecasters are using a monetary policy rule with a slope greater than 1 in their models. This is from a single survey wave, the first quarter of 2024. Let's see what happens when we roll this forward across different survey waves to understand how the perceived inflation reaction has changed. That's what we see here. So the dot, for example, one dot here for the first quarter of 2024 corresponds to the slope that you saw in the previous plot, which we saw was greater than 1. Here we see that all the way through 2021, 2022, as inflation was on the rise, the perceived inflation reaction was pretty much 0. Then, after liftoff, the perceived inflation reaction started to go up and eventually reached a level higher than 1, consistent with the Taylor principle. This figure uses completely different data and also finds that the perceived inflation reaction has increased. Here on the x-axis we have date, and for each dot what I'm showing you is the rolling regression coefficient of daily changes in bond yields onto inflation surprises over a 24-month rolling window, where each observation is a core CPI release date. What we see here is similar. The inflation reaction of bond yields remained fairly low through 2021, much of 2022, and then it increased. Moreover, the perceived long-term inflation reaction as embedded in these high-frequency bond yield responses has remained strong through the most recent data. Here I'm turning to bond stock co-movements. And concretely, I'm plotting the inflation component of bond stock betas measured as the regression of inflation swap returns onto stock returns over a 90-day rolling window. What I'm highlighting here is that this bond stock co-movement has increased in the fall of 2023. This has sometimes been billed as a return to the turbulent bond markets of the 1980s. I think time will have to tell whether we really get back to that, but there has been an increase. There is also a shorter-term peak, especially for Europe, around the invasion of Ukraine, as you can see here, suggesting that shocks on the supply side and geopolitical shocks have played a role for inflation expectations and bond market safety. There's a logical story here. When supply shocks are present, central banks, monetary policy need to choose a point on the inflation output trade-off. When the perceived inflation response is strong, as in late 2023, this means that stock markets are going to decline more in response to an adverse supply shock. Bonds also fall because inflation goes up, and a positive bond stock co-movement ensues. The increase in the bond stock co-movement that we see here hence further supports an increased inflation reaction, as I showed you before. Let's now broaden a little bit from narrow monetary policy communication to the broader environment. We already saw on the previous slide that geopolitical shocks matter for inflationary concerns and bond market safety. Zooming out, here we are looking at borrowing rates, government bond rates for the UK in dashed and the US solid back to 1870. We see that the UK enjoyed the lowest borrowing rates before World War I, when it was also the largest military power worldwide. However, it lost this privilege sometime between the big world wars when its hard power was also overtaken by the US, and the US then has enjoyed the lowest borrowing rates. In ongoing work, I have modeled the two-way virtuous cycle between geopolitical safety, low borrowing rates, and the ability to invest in military capacity. So geopolitical safety should be viewed not just as an underpinning, but also as a result of monetary policy credibility. Okay, to conclude, perceptions of the monetary policy framework matter for transmission to financial markets. It allows markets effectively to do the central bank's work for it. It can improve the inflation output trade-off, and it also matters more broadly, including for geopolitical safety. We have found that the ECB's perceived inflation reaction rose after the liftoff from the ZLB in July 2022, basically from 0 to 1. In our last year's paper for Jackson Hole, we found something very similar for the US. Further, in the 2025 update, the longer-term perceived inflation reaction of the ECB remains strong, and that's good news for the ECB's long-term credibility in controlling inflation. One big takeaway here should be that there are tools to evaluate and measure perceptions of monetary policy frameworks, and I think that's useful, especially when communication tools are under discussion. Most concretely, we have found that the rise in the perceived inflation reaction occurred after liftoff and repeated hikes. That means good monetary policy actions are good communication. That should give an additional reason to hike quickly in a potential inflationary scenario, or more relevant right now, keep easings clearly dependent on incoming inflation data. The data that I've shown you is from private forecasters, but central banks, in principle, have the ability to make similar data available themselves and thereby use this to communicate their own reaction function. I'm thinking here of several possibilities: connected dot plots, scenarios, or quantitative communication more generally. Thank you.
So among the factors that Carolyn raised in that wide-ranging presentation is, in fact, of course, the markets and everyone don't just care about the short-term policy rate. They understand, want to understand also the wider evolution of interest rates over time, not just in terms of our projection horizon, but when we look at longer-term rates, the credibility of institutions in relation to governments and so on. So in any event, this is the Central Banking Forum. The ECB likes to learn from our neighbours and further afield. This is why I'm so pleased that we have Anna Siem from the Riksbank next in our list. So over to you.
Thank you, Philip. So I'm just waiting for my slides. So thank you very much for allowing me to speak today. I'm very happy to be here, and I'm going to talk about the role of alternative scenarios in monetary policy communication. So let me start by noting that although I think that most of us agree that efficient communication is a key part of monetary policy, we have actually chosen very different strategies in this regard. And this is probably due to differences in institutional features, that we face different constraints, but also different possibilities. So at the Riksbank, the path that we've chosen is one of very high transparency, and I think that there are essentially two reasons for this. One is, of course, that we're highly independent, and with this independence, as you know, comes this need for accountability, which is facilitated by transparency. But also that we believe that it makes monetary policy more efficient if we can influence the expectations of households, firms, and markets. So to this end, what we're doing is that we try to convey the reaction function of the board by publishing a policy rate path, a forecast for the policy rate for the coming 3 years. We have been doing this for almost 20 years now with some success, I would argue. But we complement this path, complemented by alternative scenarios, which will be my focus today. And we also publish attributed minutes shortly after each policy decision, so 5 working days after. So it's quite clear who said what and who expressed different nuances to the consensus view. Now, before I get to the scenario part, let me just comment briefly on the policy rate. So this is a policy rate path that reflects the majority view of the executive board. So we stand behind and own this forecast. It is produced by the staff, but in discussion with the board, and this is very much something that we take a decision on and stand behind. It's a path that ensures that the objectives are met, so that we meet the inflation target while taking the evolution of the real economy into account over some horizon that we think is reasonable at the time. And it's also consistent with our assessment of the long-run neutral interest rate, so that everything sort of holds together in the long-term equilibrium. There are a number of properties that we want the monetary policy embodied in this path to obtain. In particular, we want it to be efficient. There should be no other path that brings us to target at a lower cost. It should also be robust in the sense that it should give rise to acceptable outcomes if things don't evolve as we foresee. And it should be predictable, so it should be in line with historical reaction patterns, and we can also benchmark against, for instance, Taylor rules and so forth. Importantly, it's revised as new shocks hit the economy, so we constantly convey that this is a forecast, not a promise. So in the language of forward guidance, this is very much a Delphic type of forward guidance. It's not a commitment to any given policy. So this is the example from the most recent monetary policy report in June. So what you see here, the dashed line is the path. We lowered the policy rate by 25 basis points. That's why you see the blue line being lower than the previous forecast from March. And it's also absorbed by the interval that we think is reasonable for R star in the very long term. So over a 5-10 year horizon, it should be absorbed by this interval for R star, which we currently think is 1.5 to 3% in nominal terms. Excuse me. So since we can be certain that the future will not evolve as we foresee, we complement the policy rate path by these alternative scenarios. And I think it's easy enough to say that, inflation could be higher or lower, and if that happens, we respond by means of the interest rate. But I think we can add clarity by being a bit more specific and by adding some detail. So if we think about what a scenario comprises, it's really a sequence of shocks. These can be one or several different types of shocks that occur at different stages. But it's also a set of modeling assumptions. How do we think about the strength of the monetary transmission? How do we think about the degree of price rigidity, the state of the global economy, the pass-through of exchange rates to prices, and so forth? And what we obtain is these alternative projections when we subject our main model apparatus to these shocks under these alternative assumptions. So the main objective of these scenarios is to convey which risks we perceive as important, but also the reaction function. How are we likely to react if this is happening as we see in this scenario? And they can also be useful for assessing policy robustness. So if we think about the baseline and we think about alternative scenarios, we could derive optimal monetary policy in all 3 cases, apply that policy to the different states of the world, and see which one gives rise to the most acceptable outcomes in all 3 cases. I like to think about scenarios as these coherent macroeconomic narratives that allow us to address the what-ifs of the economy. So this is an example from the December 2024 Monetary Policy Report. Here you see the blue line is the baseline, and then we had 3 different scenarios. One where inflation was lower, but 2 scenarios where inflation was actually higher than in the baseline. So in one of these, in the yellow one, we communicated that what if there are tariffs that increase inflation, there are second-round effects, we could think about some entrenchment, we could think about inflation expectations being affected. And in that case, we sketched a more restrictive monetary policy. So the yellow line that you see in this right panel, that would be the anticipated policy response in that case. But what happened a few months later is that we had higher inflation, but not due to tariffs, but due to temporarily higher food prices, due to a reweighting of the consumer price index. And here it really gets crucial that we did talk about the details, because some of the market participants picked up on the fact that we didn't raise interest rates as we had sketched in the scenario. And that was because the underlying inflationary pressure was different, and we didn't see any real threats to inflation expectations, for instance. So I think this illustrates some of the challenges that we see when working with scenarios. One is clearly how to choose them. How do we identify the risks that the executive board see as the most pressing ones at the moment? Should they be close to the baseline or more extreme? How specific and detailed should they be? And I think there are different views here, but one principle that I think is perhaps appealing to me at least is that if we are close to the baseline, we should pay attention to detail. It should be about the mechanisms, how we see the inflationary pressure in the economy, and not just about observing different outcomes and saying, if inflation is high, we're going to raise the interest rate. If we talk about more extreme scenarios, other challenges are that they're not easily addressed by means of the model apparatus that we have access to. I mean, if we want to model the general equilibrium effects of a trade war, that's clearly going to be very difficult. The same goes for many other geopolitical effects as well. But ideally, scenarios should receive as much attention as the baseline projections. So we should really go that extra mile, I think, and pay some attention to detail. Now, do scenarios work? They are notoriously difficult to evaluate. It's very hard to say that we have established causal effects. If we look at the deviation of market expectations of interest rates from our policy rate path, there are some episodes when they have been much more in line with our alternative scenarios. This is, of course, not to say that we have influenced market expectations, but they have at least been consistent with the scenario view, and they have deemed these scenarios relevant and realistic. And we do know that market participants study them. I'm not so sure about households and firms. We don't have any data on that. But to conclude, in my view, the policy rate path and the scenarios that we work with are useful in painting this comprehensive picture of our reaction function. I think scenarios are particularly useful when uncertainty is high. In normal times, we can be a bit more confident in the baseline, but in uncertain times, we really need to think about the what-ifs. And one thing that we learned from this December scenario that I mentioned is that if we address past scenarios in the monetary policy report, that's something that could contribute and promote credibility, in that we can say to what extent or in what regard does the actual development of the economy differ from the scenarios that we addressed in the past. And barring the challenges involved in evaluating monetary policy communication, I would say that this communication strategy has been successful. There is some indication that monetary policy has been predictable. We've seen very small market movements, for instance, in response to policy changes. And so I think even in times of uncertainty, we have been fairly successful in this regard. So thank you.
So continuing the tour of different central banks, I'm pleased that we have Alan Taylor, who's, as an external member of the MPC, he's also continues his day job as professor at Columbia University. So Alan, over to you.
Okay, thank you, Philip. Thanks for the invitation to be here. So why do central banks talk about their decisions in public? For a long time, monetary policy was decided and implemented behind closed curtains, something that I study as an economic historian. But in my view, there are two reasons why that's not a good idea. First, we explain our decisions and intentions because we believe it's conducive to both understanding of and trust in the institutional framework. In the UK, this means a delegation of inflation control from the government to an independent central bank, and then implies the independence of the MPC for setting the stance of monetary policy in order to hit the statutory target. The second reason for explaining decisions and intentions is because of a desire to affect expectations of future interest rates, either directly or indirectly by affecting expectations of the macroeconomic outlook. Today, I'm going to speak about this latter point. The question I address is, how can central banks credibly and usefully communicate when it comes to where interest rates are likely to settle in the long run? And I will argue that the arc of history bends towards greater transparency and that we, the Bank of England, still have a way to go. My individual view, and not necessarily the view of other members of the MPC, is that this is one key dimension along which we could be more transparent. And further, I will argue that I think we should be. I believe there is value for central banks in communicating policymakers' beliefs about the neutral interest rate, whether it be some collective view or that of any individual member. Now, this is not the same as forward guidance because it is not intended to affect the stance of monetary policy or be a commitment. Instead, it is about giving an anchor to the endpoint, the neutral rate, the place where interest rates would come to rest after all shocks, real and nominal, have washed out. Of course, that place is never reached. Shocks happen. But just like any other possibly time-varying parameter in our reaction function, it is something we should strive to convey, to make that reaction function ever more clear to the outside world. If we think it's important to explain the slope parameters in that function, it is, I would argue, at least, if not more important, to also communicate the intercept parameter. Naturally, since neutral is an unobservable, talking about neutral is to express a belief. And as with most of our other communications, these beliefs can be wrong. I would argue, in fact, that they are ex post almost certainly going to be wrong most of the time. I've said that before, just as in cricket, you should expect to get out sooner or later, so in monetary policy, you should expect to make an incorrect forecast. But that should not mean that we stay in the pavilion and hide. We should share our beliefs and be scrutinized for them, a test that we should be able to face. However, this raises another question. Even if we were to talk about neutral, would we actually have anything useful to say? Our expressed beliefs can only be as credible as the method that underpins them. So what methods are available? I will highlight 3 approaches in use. One method is analyzing, using models and data to gather evidence. Another is the method of outsourcing, using the market curve to gauge other people's assessment of neutral. Or there is the method of feeling our way to neutral, a view that we will know what neutral is when we see it. An objection to feeling our way by trial and error, or by hiking or cutting until something breaks, is that the ensuing mistakes from under or overshooting, or from instability or other risks, could be costly. An objection to outsourcing to the market is that the market can be wrong. I'm a little bit behind my slide here. And I'm going to show this famous or infamous chart. The market can spend the better part of a decade being wrong, actually, as we saw in the 2010s. And this chart shows the evolution of short rates in the UK and the US over the past 20 years, alongside a series of successive market curves. It's not showing every market curve. There's a degree of uniformity there. But we can see how it took several years for financial markets to realize that short rates would stay low, ostensibly because R-star had fallen in the wake of the financial crisis. In fact, it's ironic that when markets were finally fully convinced of lower for longer in the UK and elsewhere, it was on the eve of the largest inflationary shock in a generation, which caused central banks to raise rates rapidly in response. In my view, however, the recent unanticipated rise in rates was mostly due to the unusual combination of shocks and their severity, and not because the drivers behind the lower neutral rate went away. All of the structural issues, aging societies, low productivity growth, a global hunger for safe assets, all those things are still around. The link between these slow-moving structural drivers and neutral rates is not directly observable, so one needs models that embed at least some of these mechanisms and trends. Thus, my preference is for the first option above, the use of analysis. Now, a frequently stated objection to model-based endpoint communications is that the models are simply too imprecise. So let me gently push back on that idea. In the note, which is going to be published alongside these remarks, we do some exercises. We show how model-based estimates of neutral interest rates have actually been better at predicting future short rates than the bond market itself, on average over recent decades, not just in the decade shown in this chart. Our setup in this exercise is deliberately simple. We take the model's equilibrium real rate, R star, and its inflation trend, pi star, recursively estimate a time-varying intercept. We can also switch that on and off. It actually doesn't make much difference. But we think that intercept is important to capture potentially time-varying term premia, which are embedded in our estimate of the neutral rate because it comes from a macro finance term structure model. So let me show you the predictions of bank rate in that model, which are here, and also a Fed funds rate forecast similarly, with the market curves now shaded in the background. The aqua line shows the proper recursive out-of-sample forecast, and the orange line, the rule of thumb forecast with a fixed intercept. Now we see that because of the underlying measure of neutral depends on the entire term structure of bond yields and both nominal and real macroeconomic trends, it is able to react during turning points. Our main evaluation exercise is shown in the next chart, which is the Giacomini and Rossi test. Basically, you take a loss function, which is mean squared error of the alternative against the null over a moving window. And this was actually quite surprising to me. I thought the model would do well at points where pi star and R star historically moved. Maybe pi star was moving in the 80s and 90s, R star moving around the global financial crisis, and that's when the outperformance is very highly statistically significant. But in fact, the model-based estimate outperforms almost all the time with a positive number here. So that when that colored line is above zero, it means the model-based neutral rate was a better predictor of future rates than outsourcing to the market curve. That's been more often the case than not in recent decades. So I hope this will assuage some of the fears that model-based estimates of R star are fundamentally deficient or too imprecise to be a guide in real time. They are no worse than the bond market and often better at predicting future short rates. And the point is, we often seem relaxed about using the market curve to infer the endpoint, or in constructs such as the real rate gap. Yet the curve seems to have less information than the R-star models themselves. Thus, I would argue that these sorts of estimates of the neutral rate can be useful for coordinating actions and plans of economic agents in the economy, in line with a common baseline. And in my personal view, the key would be to publish these neutral rates regularly, consistently, and transparently in our monetary policy statements. I think it can be a hugely valuable thing to have a well-understood tool for communicating the degree of stimulus or restrictiveness. And without a view of the neutral rate, one cannot really have a view of restrictiveness. So I believe the MPC would be well served by finding a vehicle for communicating these beliefs. And there are many potential ways to convey these estimates, as judged by the various members, the Fed's dot plot and the Riksbank's rate path being just two examples. So I want to leave you with, in the name of transparency, an update of my own rate paths. Seems fair, since what I've just talked about. Including endpoints. I first showed a picture like this in my first speech in January. Recently in May, I voted to cut bank rate by 50 basis points, and in June voted for a 25 basis point cut. And my reading of the deteriorating outlook suggested to me that we needed to be on a lower rate path, needing perhaps 5 cuts in 2025 rather than the market implied gradual pace of 4. So previously, when I joined the MPC, I think, like many, I had seen a UK soft landing in the cards, with some remaining upside risks to inflation as we ended 2024, and as a bump emerged in 2025. But now I think that soft landing is at risk, and there seems to me a greater probability of the downside scenario in 2026, which would push us off track as demand weakness and trade disruptions build. Shocks from energy prices and food remain a big unknown, but the underlying demand-supply balance is quickly shifting as slack opens up. Beyond that, using the model as we go out towards the end point, I estimate the UK neutral rate to be about 0.75 to 1%, putting neutral nominal at about 2.75 to 3%. Getting there under our baseline scenario without further shocks would take more time and a continued removal of restrictiveness in 2026 and possibly into 2027 as the economy returns to long-run real and nominal equilibrium. However, as always, a lot can happen between now and then. Thank you.
Thank you, Alan. And the design of the Sintra Forum is we do invite of course, academics, central bankers, but also market participants. So whether here in this session or over the breaks, no doubt you may get some reaction to that. But I also picked up from Alan's speech. It might have been the first time in the history of the Sintra Forum that cricket was mentioned. The reason why I bring up cricket is it goes back to this issue that Alessandra raised about machines. Because, of course, cricket is ruled by the English Cricket Board, the ECB. And the amount of times I get alerts about the ECB and I get into a panic, and it turns out the ECB, the English Cricket Board, has made some mistaken decision. And then, okay, so, I hope maybe in your influence in UK society, you can get them to change their name. But maybe that won't happen for historical reasons. So we've covered a lot, and maybe I will try and gather some of the main points into 3 issues, and then I'll ask each of the panelists to see if they want to comment on any or all of those. Number 1 is the technology that Alessandra raised. And we do have this issue now that we hear what Reuters and your competitors are doing, and more generally, how does it change how central banks should communicate? On Monday, when we launched our own strategy review, as we did the last time, we also accompanied the technical documents, the professional documents, with kind of layered communication, including animations and so on. I think this has been successful in recent years for monetary policy, but that's just one example. So we have, how do you get to the firms and the households versus the fact we can use the market data or the survey data to assess the professional response. A second issue, as Anna raised, was in relation to scenarios. We did commit on Monday that in a systematic but context-specific way, we will make greater use of scenarios. But essentially, I mean, you were very helpful there in how you presented, but maybe the other panelists also have comments. With those 3 issues, the technology issue, the measurement issue, and the scenario issue, maybe I'll go back in turn. So Alessandra, I don't know if you want to pick any of that up.
Yeah, sure. I mean, on the technology issue, I think that, as I said, in my remarks, what we have seen is that the AI tool, which is fast and picks up a lot, does not distinguish. It does not have hierarchy. And so I think what follows from that is that there has to be clarity and simplicity, or sort of a kind of clear repetition of the message, on the part of central banks. The fact that the tools exist and they're only going to get stronger, and the fact is, with all the precautions that I mentioned, we are going to use them more. And so that's just a reality for you. And so I think the simplicity and clarity is important. On the scenarios, I'm not equipped sort of on the technical aspect. I would say, I feel like the danger with scenarios is that can they be exhaustive? And therefore it achieves to a certain extent your desire for transparency, which we all agree is a good thing, and because you're essentially telling the market that there's more possibilities. It gives you an insight into what you're thinking. But if you're not exhaustive, then and as President Lagarde said yesterday in the policy panel, we're not in normal times, and something that is a complete shock, a new shock comes out, and you have not taken that into account in your scenario, then, and the lawyers in the room, including President Lagarde, will say this, oh, well, you said it was going to be these X number of scenarios, but it's something else, how wrong were you, right? So you set yourself up in a sense for potential danger that way. So I think it's a balance between the need for transparency and the need for not to then miss something, or name something severe. But as we have seen with COVID and what has happened over the last few years, there is no limit to what severe can mean. So I think that. And then just the final point, I would say, look, for us, from our point of view, which is what I'm trying to give you, for us, that informal, scenarios or no scenarios, that informal communication that our journalists, are really experienced and knowledgeable journalists have with policymakers is very important. It doesn't necessarily lead to a story, but it gives us the understanding that pervades all of our coverage. And at the end, leads to what we think is a more reliable and accurate product.
Okay. Thank you so much. So, Carolyn.
Thank you so much I really learned a lot. I think using, in terms of measuring a perceived reaction function, I think it's possible. That's what I've been hoping to show. I like to use complementary tools, so that's why I showed separate results for surveys, which have been out there for for decades. And market data, high-frequency data around macro announcements, bond stock betas. One could try to synthesize this into one indicator, but I think I prefer to look at 3 different things and understand, okay, this is maybe more long-term assessment, maybe this is a little more short-term, this might be a different sort of clientele that we're reflecting in principle, and could extend this to households using existing surveys that have been out there. I think one positive message from this is also that it seems like the forecasters and the markets that we're looking at in our data, they do seem to price in a reaction function. Whether it's the right one or not, I think it's actually probably not too far off, but even separate from that, I think it's positive that the data seems to speak towards forecasters and markets are going beyond just the point forecast for the next meeting. They are pricing in a slope. So I think that's good. At the same time, in our work, we've always stuck to fairly simple rules, similar to a Taylor type rule with maybe inflation, output gap, maybe a financial conditions variable in addition. But we've always tried to keep it somewhat simple because the data at some point reaches its limit. Maybe we have a cross-section of 30 to 50 forecasters, maybe 4 to 6 forecast horizons. But it also seems plausible that there's just a limit to how much these forecasters can process. So they seem to be able to process quite a bit, but we've always been trying to be mindful that there's a limit to that also. In terms of which tools are useful, the data that we're using is most similar, I would say, to the Fed's dot plots with the additional tool of being connected, right? So the way that dot plots are published in real time is there's a scatter plot for rates, there's a scatter plot for inflation, there's a scatter plot for real GDP growth, but you don't know whether the person who forecasted high inflation is also the person who forecasted high policy rates. And in a way it becomes available 5 years later, but basically the data that we use for private forecasters is like having this connection in real time. And I can't really comment on the practicalities of either scenarios or this sort of exercise, but for us, it's kind of, what I find useful is that it's basically like generating experiments. One person predicts more inflation, there was team permanent about inflation, there was team transitory, and how does this translate into different policy rate forecasts?
Very good, thank you. Anna?
So I think in addition to what I just said about scenarios, maybe just a comment on whether we can be exhaustive. I don't think we can. There's always going to be black swans, circling above, waiting to hit, right? So, but I don't think we should let this drive for perfection get in the way of using a tool that I think can make us more predictable. So I think that we can capture the risks that we see as important, and I think that's good enough.
Thanks, Philip. Thanks for the cricket suggestions. I'll try to take them up. I'll come back on scenarios too. Coming on a panel, it's not interesting to really listen to yourself. It's interesting to listen to others. Anna's presentation, I thought, was really great on summing up scenarios and how to do it. So we've been doing them for a while internally, many central banks, but now the question is, how to present them externally. And I think that's an art that's emerging. And how best to do that is a big question. I agree we can't be exhaustive, otherwise you're going to end up with, some kind of new fan chart with 1 million lines on it. And that wouldn't be very helpful in terms of communication. I think what Christine said on Monday night was important. They have to be context specific. They have to relate to some economic mechanism and economic story that's developing. And that's going to need work. And you will have to figure out how to update that so it's not stale and so that it's relevant And I think that needs more figuring out. One question will be, how extreme should the scenario be? Are you looking for the 60th or 70th or 95th percentile? Then you're talking about very different kinds of events with different responses and risks. I think there's a danger in scenarios. I'll switch from cricket to golf, since we're at Peñalonga. There's a danger that it becomes like picking the golf club, like, you know, well, here's what the 7-iron does, and the 9-iron puts it up there, and the 5-iron puts it down here. And it, well, yeah, actually, for me, it goes over there. But there's a danger that you just have an upside, a downside, and a middle, and it becomes kind of mechanical. And I think it has to be more grounded in an economic story than that. But I think the key is, and it's conveying the reaction function through what you're saying on either side. It's got to have an endogenous policy path. And I think, as Anna's presentation showed, that should be anchored around where you think the policy path is going, based on what I just said. I guess the last question for me is, in addition to showing these scenarios, are you going to speak about the probability weights that you attach to each one? Is that useful or not? Or do they just sort of sit there to be stared at, but no one's quite sure what the risk is? So I think there are still many moving parts to work out.
And that issue is, of course, reinforced by many things are happening which are not in the historical data set. So trying to say, well, based on historical averages, this is the probability, doesn't get you so far in some cases. Yeah. So Alessandra, please.
Just a quick question. When you were speaking, sorry to speak out of turn, but a question I would have on the scenarios also is, does it potentially subject you to political risk? So if the scenarios are tied to policies, so in the case of higher tariffs, this could happen. Could you be seen then as promoting one policy or another? And I don't know the answer to that, but it seems like a potential risk.
It's, at least from my point of view, it's something we definitely take into account. But of course, in the end, there's a reason why we're independent. You do have to kind of call out what is relevant for decision making. So I see. I'm just going to go in the order of how I see people. So Isabel has the advantage of being right in front of me. So Isabel, then John Williams, and then Steve Cicchetti. Okay.
So thank you very much for a fascinating panel. So actually, I mean, so we have a panel about central bank communication, and most of you talked only about how we communicate to experts. But actually, I think what also matters greatly is how we communicate to the general public. And I would say we're pretty good at communicating with experts. I mean, we can improve and have scenarios and so on, but we're already at a pretty high level. But we may not be as good as talking to the general public. And of course, we have a situation where there is a general mistrust in institutions, in elites, which makes it very hard for us to communicate to the general public. I mean, we've all had our experiences. I mean, in our case, for me, the most extreme experience was we had back then in the old days, we had this narrative of the expropriation of the German saver by the ECB. And that was a very powerful narrative. And I tried hard to dispel that, but it was actually very hard. So, of course, when interest rates are high, you could also, at other places, have the narrative that a central bank is unnecessarily imposing a huge interest cost on a certain government. And the question is, I mean, how do we deal with that? And I think it's really hard. So there was one of the Young Economist papers, which is very interesting, said the messenger matters. And it matters how similar you are to the people you talk to. I mean, we are not similar to the general public. Let's face it, we're a bit special. We're similar to the experts. We are not so similar to the general people. So do we need different messengers to convey our messages? Do we need to do much more about things like financial literacy in order to make sure that people are better able to understand us? So what is it that we have to do in that area? Sorry for the long question.
Thank you. John.
So first and foremost, I want to congratulate whoever organized this session. This was awesome. It was great bringing the policymakers, academic, the world of journalism together in one conversation rather than one or the other. So that was, and each presentation was terrific. Second comment, again, on the positive, Anna, it was a fabulous presentation, but I also just want to applaud the Riksbanks and quite honestly the Norges Bank and the Reserve Bank of New Zealand for decades of kind of showing the way about transparency and clarity along a lot of dimensions. We all learn from your experience, and your presentation adds to that in terms of what you've been doing recently. So I think that's great for these central banks to be experimenting some, and we can all learn from that. So I guess I have just two quick questions really. One, and maybe it picks up on Isabel's question, but a little bit differently. A lot of the ideas that are out there in the academic world are being discussed, and scenarios is one, seems to be the attempts by central banks to tell a bigger picture, tell more information, give the full picture. Let's give you 100-page reports in a way. When I think about the new technologies and AI, it wants to simplify to very crisp, short messages. So I guess there is this issue of how do we make sure that with AI and other technologies that fuller picture gets conveyed, who are the audiences for that, and how do we do that effectively? And I guess the other quick question is around scenarios, is really how we think about what's the kind of scenario that we think is most effective. I mean, I think, Alan, you might have said this, is like, this variable's up, this variable's down. These are all endogenous variables. So is it better to think of scenarios as one as some kind of factor, driver is happening? I'm going back to my youth when productivity growth was the big question. So you could ask the question, is productivity growth higher or lower, and then work out what that might mean for the economy, as opposed to this endogenous variable moves in this way versus that. And I just think it's an open question. So again, just a fantastic panel.
Okay, thank you. Steve.
Thank you very much. I'm Steve Cicchetti from Brandeis University and the ESRB. Let me echo what John said without repeating it about how great the panel is. I want to take what I view as a very unique opportunity to ask a journalist a question.
I'm not used to answering questions. I'm used to asking questions.
It was a terrific. It was absolutely a terrific presentation. But I think all of us in this room have played around, and some of us use these tools more or less intensively. And one of the ways you can use the tools, if you're writing a report, for instance, is to put the report in and see what the executive summary is that the tool gives you, and see whether or not it actually matches up with the executive summary that you want. And if it doesn't, maybe go back and rewrite it. So my question for you is, there's a form of an arms race going on here, where the central banks are now going to use the tools to figure out what you're going to do with the tools, and to try and maybe manipulate you and your colleagues into writing stories that look particular ways by producing things that then yield AI generated content of a certain kind. And I'm just wondering how you react to that problem or think about it. Thank you very much.
Okay, so I'll invite whoever wants to pick up any of those points. So Alessandra, if you have any response or...
Specifically on this one, yeah, you're right. I mean, it's an arms race. It's an arms race increasingly, not just sort of between or among us and the other news agencies that are doing similar things, and it's with the investment banks that are doing a lot of this, and with the central banks that are doing this. But that's why. I'm going to answer in a couple of ways. We are so careful to include the human in this loop. The news judgment is something and context is something that the machine has not understood, and so we have oversight of, and the human is very much part of the picture. That's the first point. The second point is sort of what I got to at the end, which is, we don't just, I spoke a lot about what we provide to the markets because it seemed like the right thing to say here, but a lot of what we do, I would say even more of what we do is actually go out there in the street and report, and that's not just with policymakers, but it is with people on the ground. And so we supplement what we report and what we put out, of disclosure news, we supplement it with investigative work and going out there, off the record conversations, and that is the huge value, right? The insight, the analysis, and the AI tool allows us to do more of that. So that's why we're so excited about these tools, because it lets us go beyond, and that's our, that would be our response. And just one other point is to the point of speaking to a public. A lot of the information that we get from press releases and sort of the raw information that we put out into the market is essentially for the terminal. It's essentially for professional audiences. The insights, the analyses, the special reports that we write, those, all of our data shows, are read equally and consumed equally by a professional audience and the sort of market operators as they are by the media audience, so by our clients who are giving it to normal people, more than 1 billion a day, every day. Those are equally as popular. And that indicates that the public does want to know about these issues, but they just need, this is self-serving, but they need the journalist to explain what it means on the ground by speaking to the person whose mortgage has risen or fallen, or what something that's happened in Ukraine means for your prices at the pump, and that's what we do.
Okay, thank you. Carolyn?
Yeah, fantastic questions, and I'll say something about Isabel's and John's points, which I think are connected. And so in my QJ paper with Michael Bauer and Adi Sundaram, which we wrote for the US perceived reaction function, one of the findings was that the perceived reaction function moves after the classic monetary policy surprises measured as the change in in interest rates in narrow windows around monetary policy announcements. Now, why should that happen? Well, if you see a surprise hike in, say, an expanding economy, you might infer that interest rates have a higher coefficient on output. Or conversely, if you see a surprise increase in a weak economy, you should infer the opposite. And that's exactly what we find in the data. Now, what does this tell us about how much these professional forecasters know about the central bank reaction function? It tells us that they don't fully know the central bank reaction function. If it was perfectly known, there should be no response. And so that tells us that despite the intense communication efforts that have been there for decades, even the professionals don't fully know the reaction function. I can't fully extrapolate to households, but my guess would be that they're having an even harder time. That doesn't mean that communication isn't worthwhile, but I think it should be evaluated as we move along, and I think actions sometimes hit the mark.
Thank you. Anna?
So first off, thank you so much for the kind words, John, and I appreciate that very much. Excellent questions, difficult. Isabel, I think you're spot on. I think we need to understand why the inflation expectations of households, for instance, differ so much from actual inflation rates. And that could be linked to financial literacy, as we had also in one of the young economist talks, right? So very interesting. I think we need to have a communication strategy where we communicate differently to different target groups, right? And I think in terms of scenarios, we need to have, for internal use, a very specific idea about what we're doing, what are the assumptions, what are the specifics. But in terms of communicating towards households, maybe we could be a bit more concise and just, the main point is that it might not, evolve as we foresee in the main scenario. And for investment decisions, if you want to buy a house or whatever, it could be that, that's enough that, you shouldn't take this as given, so to speak. Maybe we could publish technical appendices to go with these statements. I'm not sure, but we should think about that.
Thank you. Alan?
I second what Anna just said about communicating data. It's not just about explaining the stories, but if you feel like, the misperception out there, I think that communication channel, particularly with households, as she mentioned, is very important, and we can do more of that. I think our challenge as we go to more channels, if you like, of communication is consistency. If we're trying to reach different audiences, I think it's very important that the message be consistent, because it would be a terrible accident to be find yourself with different messages and be caught out on that. And I think that's an art of storytelling, that our economic models are ultimately stories about how mechanisms work together. And I think it's just a matter of crafting those messages appropriately. And And then the last thing I wanted to pick up on was the political risk and, can you talk about the impact of fiscal policy or trade policy? Well, of course, we have to do that because it's going to affect the trajectory of the economy and it's going to move the output path and the inflation path and require a response from the bank. So it's going to be part of the story we have to tell anyway as an independent central bank. So I think you would only repress that if you were a non-independent central bank, but
Very good.
I don't want to be in that world.
Okay, so the next set will be Jordi, Michael McMahon, and Annette Vissing-Jorgensen. So, Jordi.
Just Jordi Galí, Crayon UPF. Just a quick comment on Alan's presentation. I think I agree completely with you that it's critical to be transparent about the long-run neutral rate, while acknowledging uncertainty about it, as the Riksbank does. Yeah? And the analogy of it is, asking Google Maps for the best roads to take, given the current congestion, without telling it what your destination is. No? But I'm a bit so. But I'm not sure that the approach that you described is one that would be useful for central banks themselves in order to make inferences about that long-run neutral rate, because it's based, if I understood it correctly, on estimating the intercept of an interest rate reaction function, which, if anything, would capture what is the long-run neutral rate that is consistent with the policy that the central bank is actually pursuing, and hence maybe based on their own estimates of the neutral rate. But I think we should go beyond that, and from the point of view of the central bank, it's interesting to understand, to know what is that long-run neutral rate, which is not something that they choose, given their choice of the inflation target. No? And for that, we need to go beyond that approach and to use structural models that incorporate the forces that we believe are the drivers of that long-run real rate, like productivity growth, demographics, preference for savings, and so on.
Thank you. Michael?
Michael McMahon, University of Oxford. I'll just make one comment. The second part of Ben Bernanke's famous 98%, 2% statement is the cost of sending the wrong signal can be high. And it's come up a few times, conditional statements being interpreted as unconditional, despite your attempts, forecasts being taken as promises. So I guess the general question is to the panel, how do central banks best convey the uncertainty? Or put another way, is the fan chart dead, or is there life in it yet?
Very good, very good. Annette?
Yeah, I want to touch on the issue of disagreement. As you all know, a lot of the communication from committees comes from the fact that people don't really agree that much. And so there's a big distance between, for example, the Riksbank approach of conveying a committee consensus to, say, the Fed's approach of having a dot plot and potentially connecting the dots. I wanted to ask you a general assessment of how much of that disagreement, should one discuss and convey in the formal communication, in the sense that does conveying that facilitate an understanding of the committee's collective action function, or does it cause just confusion about it?
Very good. So because I'm mindful we're hitting the limit, I'm just going to ask Rafet to make his question, and then.
This is for Alan, but Phil, you may want to actually take this, or any of the policymakers here. So if you wanted to communicate the policy rule clearly, would you be able to do it? Is there a rule that you yourself are aware of, and say that this is how we make these decisions? Actually, we don't tell you, but it's there. Is this a communication problem, or is it a existence of a rule that is actually carried over more or less unchanged from meeting to meeting?
Very good. So I'm happy to hand that one over to Alan.
Okay. So do we really have a rule? I'll take the questions in reverse order. So as I wander around Threadneedle Street, there are pictures of banknotes, and I often, if I'm ruminating or thinking, I'll stare at the £50 note and the picture of Alan Turing and say, well, if he were here, he could probably just design a machine that could replace all of us. But we're not there yet. I think we all have models and rules that are fuzzy. They're affected by noise. They're evolving. So we're not in that kind of deterministic mechanical world yet. On Michael's point, I don't think the fan is dead or should be dead in the sense that scenarios are not a substitute for the fan. They may be a complement. And there's actually a danger that if you just go to 3 lines instead of 9, it's suddenly they're just precise lines, and you're actually hiding the fact that in fact all forecasts are subject to noise and more noise as you go further out. So if that somehow got forgotten or left behind, that might be a retrograde step. And then on Jordi's point, I guess following Andrew, I was just trying to be humble and do a little nudge here, kind of make a very modest point that we put a lot of weight on the market curve and we use it as a benchmark and we trust a lot in it. And this was just a kind of horse race to say, well, actually, does it do that well? Well, alternative models might do better. Here's one. Should that be the only one? Maybe we need to go to a world of ensembles and model averaging and trying to figure out from a variety of models appropriately weighted where we think the best estimate of that long-run neutral rate will come from. But I think that would be a constructive step. And I'm arguing particularly in terms of communication, getting away from tactics and more towards strategy of where are we going. I think it helps in that regard. And as I said, I think the Riksbank example is a good illustration of that.
So, Anna, don't
So just 5 seconds on Annette's question, perhaps, because I know we're out of time. But I think you're absolutely right. I mean, institutional differences are a huge thing, and that for the Riksbank with 5 members on the executive board, it could be easier for us than for the FOMC. So absolutely, that's a very good point.
Very good. Caroline, do you have any?
Yeah, you know more about the internals of the Fed than I do. I think it's a fascinating question. We have found in looking at the connected dot plots that are available with a 5-year lag that the connection, the relationship that you find has some differences, but also has some similarities in terms of the implied rule from private forecasters. So it doesn't seem crazy, but I think the broad message is kind of numbers on different outcomes, different policy rules, whether it's connected dot plots or scenarios, is a good thing. Regarding Refet's question, I mean, the plots that I showed you, if I said monetary policy rule, I misspoke. I try to be careful and say reaction because the implied reaction varies so much over time. So in a way, what I've showed you, I think, looks more like a highly time-varying reaction function than a constant rule.
Very good. Alessandra, if you have any?
Really quickly, I mean, on the disagreement issue, all I would say is that it is hard, my experience sort of is more than 30 years as a journalist, it is hard for things not to come out. If there is disagreement and it exists, it will come out. And so, and again, this is self-serving to a certain extent, but, that disagreement or difference of opinion, in the hands of a professional journalist who understands the context of what it means can then be explained. And then just on the issue, financial literacy, Isabel, you raised it. Financial literacy is key. Young people now, let's face it, they don't trust mainstream institutions. They don't trust central banks. They don't trust, traditional media. They get their news from TikTok. That is the way they get it. And so from influencers, a recent report showed that the rise of influencers in spreading news is incredible among the young sort of 15 to 25-year-old crowd. And those are our consumers. So I can just say what we are doing, because we do speak with the public, is we are embracing these formats. We have different formats. We work with the social media companies. We are on TikTok. We are on YouTube. We are even on Twitter, X, because that is the way to reach the younger population, and that is just a fact. You can't fight it.
Thank you. So maybe in closing, I'll make 2 points because Rafet asked a really sharp question. So what I would say is, from my point of view, the reality is, there's a whole family of future rate paths. And rather than obsess about, this one over here versus one very close to it, what we've tried to do with the criteria we've used to say, well, if you're trying to work out where in that space we're going to be, on top of the looking at, because you said all you can do as an academic is look at simple rules, on top of expected inflation, underlying inflation, the strength of monetary transmission will help you move around that kind of family. And maybe just coming back to the 298 ratio of Bernanke, I mean, I think we didn't quite settle everything here, but I do think in communication there's maybe some combination, 2 pages to explain the most recent decision. So being simple, being clear, and then 98 pages to go through the nuances, the scenarios, the model assumptions, the risk assessment. Maybe that's where we'll end up, maintaining 298, but in a different sense. So with that, let me thank my panelists for a really interesting session, and let me hand it back to Claire.
Great job.
Very good.
Yeah.
Thank you for what was really a fascinating discussion, and it really, struck me that in an era of AI and massive levels of uncertainty, whether you're a news organization or a central banker, it's going to be as much about what you choose to leave out as what you choose to put in. Otherwise, I think the risk is going to be that, the story is going to be lost in time like tears in rain. Thank you. And I'd like to say now we're going to go for lunch. We need to be back here at 2:30 for what promises to be a great session on Europe's potential growth. Thanks a lot. The euro area has struggled with relatively low growth and productivity for many years, with the gap between here and the US widening at an increased pace since the pandemic. Our next part of the programme will look at what officials and the private sector can do to rectify that. I'm delighted to say the discussion will be moderated by Beatrice Reda Di Mauro, Professor at the Geneva Graduate Institute and President of the CEPR. Professor Di Mauro, the floor is yours.
Thank you. Last year, Mario Draghi and Enrico Letta delivered their long-awaited verdict on the state of European competitiveness. And by abusing a joke that Jean-Claude Trichet used to tell repeatedly, if you had to summarize this in 2 words, no more than 2, it would be not good. If you want to take 3 sentences, then the already cited gap is prominent, the gap in productivity, in technology that has been opening, but also the financing identified and the investment savings gap identified as one of the issues in Europe, the energy price competitiveness, consequence of the Russian aggression, but with us for a while. And last but not least, the fragmentation in the single market, which has been quantified by the IMF staff of being somewhere in the area between 40 and 110 tariff equivalents within euro area countries. So an additional layer of this year is that we have the fear of global fragmentation, geopolitics, and for Europe, clearly a fear of being left not behind, but alone, and therefore the need and imperative to invest in defense. For a strong Europe and for a credible defense strategy, economic strength is an absolute prerequisite. It's no longer good to have, it is imperative. So how can we enhance Europe's growth? I have with me the privilege of a fantastic panel. And on my right-hand side, I start with you, Philippe. Philippe Aguillon is professor of the Collège de France, INSEAD, and LSE. I was going to get there. Let's put that first. He is the world-leading expert on growth, technology, innovation, and probably one of the most cited scholars ever. Pro domo, I also want to say that he has agreed to and will be very soon initiating to lead a research policy network on productivity, innovation, and the social model, together with Alexandra Roulet for CEPR. Lars Feld is a chair of economic policy and constitutional economics at the Albert Ludwig University of Freiburg, and he is the director of the Walter Eucken Institute. He has a very wide experience in advising governments, especially in Germany, and is therefore one of the most well-known experts on economic policy, in particular in Germany. We have about 30 minutes time for discussion between us, and then we will open to the audience. So my first question goes to Philippe. I'm giving you a magic wand, and you please give me your 2 main wishes for what you'd like to have see in the euro area if you had such a magic wand.
Yeah. So just a few words of thanks so much for inviting me. So the kind of diagnostics is that between 1945 and the 90s, the EU per capita GDP was catching up with US per capita GDP, and as of the 90s, the gap has been widening up again between US per capita GDP and European per capita GDP. The thing is that during those years where we were catching up, it was a kind of imitation-led growth. We had to reconstitute our capital stock. The Marshall Plan helped. We had to catch up with the technological revolution introduced in the US in the 19th century, 1920, the electricity revolution, and that the education level in the EU helped. But then we exhausted the power of imitation, and we had to move towards innovation-based growth. And it's precisely at the time where you had the IT revolution in the US, and we were not able to fully take advantage of the IT revolution. Why? Because we don't have a proper ecosystem for frontier innovation. And then we get to the Draghi report. We don't have a true single market for goods and services. We don't have a proper financial ecosystem of innovation. And we don't have a sufficiently efficient public policy for innovation. Okay, so that's the big picture, and that's what Draghi, Letta, Bocconi report are all about. Okay, so at the EU level, things that I would try to do, for example, an obstacle to the single market are the gold-plating practices. Each country adds its own regulation to overall regulation. There is a Mario's paper in the Financial Times a few months ago that said that the barriers within Europe are bigger than the Trump barriers towards Europe. So that we have to do something, and we can fight the gold plating. The second thing is to create, an ecosystem, financial ecosystem, more securitization, more venture capital, more institutional investors. And Sweden tells us, and I'll get back to that, how you can, even without moving fully to a fully funded system of pensions, you can create institutional investors. So you need to have the financial ecosystem of innovation, and you need more targeted, you need public innovation policy that are targeted toward high-tech breakthrough innovation. And so far, we don't have the instruments in Europe that target that. So I don't want to be too long, but things that you can do, fight gold plating practices. The Draghi report and others, you mentioned that we can be much stronger in fighting gold plating practices and the over-regulation by each member state. Then the other thing, I would push for laboratoire d'excellence européen. In France, where usually most of the things we do in France don't work very well, but one good experience is the laboratoire d'excellence. When we created, that was Sarkozy, the LABEX, the laboratoire d'excellence, my friend Antonin Bergeau and other co-authors, Antonin was here last year, showed that the LABEX had a big impact on frontier innovation in industries that were geographically and technologically close to the LABEX. We should generalize the LABEX to European, and that's why I'm in favor of creating a ERC for labs, not just ERC for your individual grants, but extend the ERC for labs. Macron took the proposal on the 5th of May. And we don't have anything that are like the DARPA, like the Advanced Project Research Project. We have the European Innovation Council, but it's not a DARPA. You have the Bocconi report, to which Monica Schnitzer, myself, Jean Tirole, Daniel Gross, it's not at all a DARPA. We need to create in areas like health, defense, energy transition, the equivalent of DARPA, and we need to do that at European level. And I am in favor of a coalition of the willing approach. I think we should do it with those who want to do it. We should align on the max, not on the mean. And then, qui même me suivent, who want to do it with me, come with me. I think those are the kind of things that we should, that we could push.
Okay, thank you so much, Philippe. Magic wand over to you. 2 wishes?
Well, is it a time for wishes? Well, I share the diagnosis that Philippe was making, and I think we need to take into account the difficulties that the implementation of these ideas have in political environments. So there is this nice word by Moritz Scholarik saying it is improbable that governments find the winners of tomorrow, but there's a high chance that the losers of yesterday find the government. And this is one of the problems we have to face. So what Philippe was just saying is very open to what we call horizontal industrial policy. creating environments, creating frameworks that allow innovation in several different areas without knowing what is the next area that is important for innovation and therefore also for productivity gains and growth. But as soon as we are concentrating on particular firms and industries, it's becoming difficult. And therefore, one of my wishes is that we are returning to this broader perspective in creating innovative environments, instead of thinking that we know as governments, as the state, what will be the technology that has to be chosen. There's one exception, and Philippe also mentioned this is defense. Just because in the case of defense, you are interested in the fact that the cutting-edge technology that you develop cannot be used by someone else. And therefore, DARPA and the interaction that we have between the military-industrial complex in the US and the innovators that you find is successful. Yeah? Although they also wasted some money, but they are more or less successful in that regard. And the idea here is that the government, the state as the sole demander, a kind of monopsonist, a monopolist on the demand side, is having an influence on the outcome. But there must be this kind of monopolist in the defense area, and this is different. And when you're extending this idea, it also has implications for regulation. It has implications for competition policy. Regarding competition policy, I would not say it is the creation of European champions. It is rather the possibility to have the spin-off from the research side, from universities, from research centers, to industry that should be allowed to a larger extent than we currently have.
Okay. Can I add a word? I mean, I just want to, I know it's not. In fact, the problem with Europe, I mean, the problem with Europe is that it has been very much, we are very much perceived as a regulatory giant and a budgetary dwarf. Maybe it's wrong. I mean, for example, the Maastricht Treaty, I am in favor of Maastricht and the 3%, but we used to put on the same footing dépenses de fonctionnement and investments. You see, we need to put the deficit due to pension system not working well and investment. We should not put both on the same footing. I think we should not treat the same way spending to just, fill up deficits. In France, we have a pension system in deficit. So one thing, but another thing is to invest in growth. So that has to be changed. We cannot put all spending on the same footing. Second thing, we have competition policy, but we use pretext of the competition policy to preclude any form of sectoral state aid. We have to admit the idea that you can do industrial policy, which is pro-competition. That's exactly what ARPA does. ARPA, the money comes from the ministries, they have team leaders, and then they elicit competing projects. So there is a way to do industrial policy which is pro-competition. Mm-hmm. And I think that we need, so it's not that we should have to change the doctrine, but we have to implement those things differently if we want to really wake up and become a pro-innovation space. Yeah.
You have already answered partly what I was going to ask you, but only partly, because my question was going to be twofold. On the one hand side, we do need to mobilize public funds for financing the commons, to which R&D presumably belongs.
Yeah.
On the other hand, we need private, mobilizing more private investment.
So maybe on this, first we have the resilience funds from COVID. I think it was, maybe I will say something very stupid, wasn't it around the order of more than 600 billion euros? We spent half of it. Alors, it's a resilience facility. Yeah? Alors, France, of course, spent already everything, so that's a problem. So it's very difficult to answer the kind of question. You are French, because they say, okay, again, the French said that you can spend, but other countries can, and we can still spend the interest on this. So we have the resilience funds, okay? We can do a lot with them. So I think, and to go defense, of course, but defense, we will get back to that. Defense in a broad sense. Defense is not just to build ammunition, it's also AI, it's also technology, but we will get back to that, okay? But then I think that on the financial ecosystem, I mentioned before, venture capital, we can have much more. Institutional investors, of course, we have pension systems which are very much repartition, pay as you go, not fully funded. That makes it hard to have institutional investors. But Sweden is a very interesting, we had where is our Swedish friend? You are there, you know that very well. You have the pension premium system, Okay, 2.5% of taxable income of the Swedes is automatically allocated to a pension fund, and they can choose the investment, and that favors IPOs. Sweden is doing much more IPOs than everybody else in Europe. And you also have, you can invest in small and medium-sized enterprises through saving accounts which are fiscally advantageous. For example, you have the investeringssparkonton. Is that what you call the ISK? We should emulate that. When I don't even think everything. I'm very pro-Sweden. My friend is in Sweden and all that. But but that's the thing. I would criticize education reform in Sweden lately, but that on institutional investment is very good. We should emulate what Sweden is doing on institutional investors. And bank securitization, I don't want you to, between, what we did that led to the global financial crisis, which was maybe too much, and maybe too restrictive approach we have to it in Europe, there might be a middle ground. Maybe we can allow for a little bit more of bank securitization. And I think we have ways that, so I think public-private effort, but that would, and I think those are some levers, the pistes to maybe, move in the direction of a more friendly financial ecosystem for innovation.
We are going to get back to defense in a moment, as you said already. But before that, Lars, I wanted to turn to you on energy costs. One of the pain points is higher industrial energy prices in Europe, and the prediction is that this will remain for quite a while until the renewables are sufficiently built out, and the gap, again with the US in this case, is going to diminish. In the meantime, and the EU has just opened the door for that, we have the not only discussion but also the implementation of subsidies or other schemes to lower energy prices for energy-intensive industry. I think it is important to also mention that this opening of the door from the EU side framework is temporary and is coupled with the build-out of renewables. Now, to you the question, is this a good idea? Are we going to become more competitive or less competitive by having this temporary subsidy to energy prices?
Well, I'm skeptical of it because I fear that it will not remain temporary. The pressure to introduce something like this, in particular coming from Germany, is strong from the energy-intensive firms. And when you look at them more carefully, you realize that what they are exposed to, meanwhile, is the higher carbon prices they face. And there is the interaction with climate change. So when we have an efficient instrument to cope with climate change, it is carbon pricing, in particular because it allows the international coordination much more than any other instrument can do. Subsidies have difficulties to allow for this coordination, and well, the pure legal regulatory part is also not doing this. With the subsidies for the for the energy-intensive firms that are now allowed by the EU, you are also endangering the climate change policies that are important. So I'm critical of this. I fear that we are discussing the energy market problems that we have on the one side, we are too strongly in a national way. When I think about the electricity market and look at this,
it is a particular problem in Germany, right?
Yeah, but it is particularly a German problem. That's what I mean. Okay. It's to a larger extent a German problem than a French problem, for example. Yes. Or even an Italian problem, although there's also no nuclear energy in Italy. But at least Italy has cheaper gas that it can get and cheaper oil that it could get from Tunisia and so on. So there is the possibility. The possibilities are different. And what Germany has done in the last, decades, I would say, or at least the latest decade, it has isolated itself in its energy market more and more. And this is one of the possibilities that we should use. And this is also bringing us to the questions of completion of the internal market. If we had an internal energy market, it would help us in several respects. And therefore, I'm critical of the subsidization. I'm much more in favor of completing the internal market in that regard. But I'm also happy that Philip mentioned Sweden as this shining example. I would generalize this to the extent that we have a larger role of fully funded systems in our pension systems. The national capital markets work better. So it's not only a question of capital markets union, also each member state can do something by increasing the fully funded part of their pension systems. So second pillar, third pillar ideas that we already had in the past, not only the enhancement that Sweden has for its first pillar. So these are the ideas you could follow in order to have better possibilities there.
On energy, can I say something? I don't want to.
Sure.
In fact, in Europe, we had very much the carbon tax approach, okay, carbon pricing. And I believe very much in the virtue of carbon pricing. In the US or elsewhere, there was more the industrial policy, IRA. Well, I'm not a fan. I believe we need both. The Blanchard-Tirole report 5 years ago, I pushed very much with Nick Stern, saying, don't do only carbon tax. You cannot do only the stick. You need the stick and the carrot. We had the yellow vest movement in France because we increased the price of even gas oil, but people didn't have alternatives. They didn't have trams, they didn't have S-Bahns, they didn't have, so there was the only way. So there is no way you can succeed without having both the carbon pricing, which is the stick if you don't do it, but you need to create the alternatives. And the alternative is green innovation. We won't get out of it without green innovation. Innovation to mitigate, to slow down the global warming, new source of energy, using less energy, the adaptation innovation, the dikes, the air conditioning system, and the amelioration. There are people who work on how to cool the air. I know people, when I say that, people, the whole physics department of Harvard works on that, geoengineering. We need the green innovation, and we need to push. That's why we need the green DARPA, okay, with green ARPA. So I think you need the two legs. We will give you alternatives. If you don't use them, then we have the carbon price. But just imposing the carbon price is to have punishment energy. People don't want that. You need to provide alternatives. You need the two legs, carbon price and green industrial policy. And we need both. Having only carbon price will not get you there, I can tell you. Yeah.
Well,
you need both.
I'm a bit more critical of this. As long as this is pure innovation, it's fine. But as soon as we are subsidizing old industries to a larger extent, and we don't even know what the new technologies are bringing them. Well, when I think about the steel industry in Germany, for example, it will not work in that way. Yeah? So we are trying to compensate them for the adaptation they need to accomplish. And I think it will lead us nowhere. If it is really a technological advance in the pure sense, it's a different thing.
No, but you direct the technical change. You can direct it. Yeah.
And which is why it is important to mention that it is a temporary measure coupled, conditional in fact, on renewables build-out.
Well, I realized so many temporary measures in the past that became permanent. So I'm...
like taxes,
taxes, for example. All those tax subsidies.
It's good, there is a debate. That's good, that's what we want. Yeah, excellent. Okay.
Philippe, the opportunity to talk about the opportunity of defense. And let me say something.
Yeah, we talk about defense, exactly.
So just a word on this, because I mean, the approach is now to, agree on the number, 3.5 to 5. And of course, that is not the way that you would typically do something if you wanted to do it most efficient way. You don't say, I'm going to spend X, and you know, how much do I get for that? So the question is, how do we do this effectively? How do we make it in such a way that it creates spillovers also to the civilian and to growth?
Yeah, so I think it's good. I mean, there is a good effect of Trump. It wakes us up. Voilà. That we realize that Europe cannot do business as usual, sheltered forever under the American umbrella. We need to wake up, okay? And I'm very happy that Germany broke its dogma of budgetary balance, advocate massive investment, including in defense. I'm happy that the European Commission has agreed to exclude defense from Maastricht's 3%. Britain is re-engaging with Europe. What's fantastic to have Starmer with us. Voilà, offering to contribute its defense capability. That's all great. But these developments, you see, we have to be aware of some possible mistakes, okay? One mistake would be to sacrifice fundamental research by exclusively prioritizing defense or adopting an overly narrow view of it. Okay? China has become a primary concern for the US, mainly because of its impressive, spectacular technological advancement. So we need to have a broad view of what we call defense. AI is part of defense. Many things are part of defense. It cannot just be, we will build ammunition. That would be very backward. So we need to have a view of defense which is broad. Voilà, that's the first thing. Not be narrow, but go into technology and technological catch-up. Second thing would be to revert to outdated Colbertist. I love Colbert, okay? I'm a big admirer of Colbert. But we have the word Colbertist style industrial policy, where governments vertically and discretionarily allocate public funds to particular firms that they select as national champions. As I said, we lack institutions like the ARPAs, which is the way to avoid the champions. So we have to say there is a domain which is important, but we have the top-down part, money comes from it, but then we let the team leaders elicit competing projects. This should have to be pro-entry, pro-competition, and we should avoid the pitfalls of a too top-down Colbertist approach. And particularly, beware that in the European industry, especially in defense, suffer from a lack of competition, and therefore they fail to innovate sufficiently at the technological frontier. We have to insuffler de la concurrence. Yeah. I think it's very important.
Now, you didn't mention European common procurement or European common funding.
Yeah, but that would be part of the funding. That would be part of the resilience could be used. But we should use them in a way which is very DARPA-minded and with public-private. Right. You see, when we build railways in France or in Italy or everywhere, it was a private-public, to go to Marseille, c'était le PLM. To go to the West, c'était les frères Perrer. It was a public-private collaboration. And energy on the one hand or defense on the other. Again, we should have a public-private partnership.
Mm-hmm. Mm-hmm. Do you want to add anything?
Yes.
Especially in view of the big German budget for defense?
Yeah, well, I have to add, in particular when I heard this name Colbert,
No, but I love Colbert. He's a great guy. I mean.
Yeah, you love it. This is no surprise to me.
But I would not emulate. I would not redo this.
So it's interesting to say instead of a top-down Colbertism, we needed a bottom-up Colbertism. I don't know what a bottom-up Colbertism is.
No. That's why I say don't do Colbert.
Don't. Yeah, well.
This is the man who did Schumpeter, right? So
yeah, no. I know pretty well. You don't have to explain to me. I read this book up and again. Okay. Yeah, well, but. Being careful of this, channeling these funds that we now have in Germany. So it's actually an exception from the fiscal rules, not only in Europe, which is only temporary, but overall in Germany, which is not restricted in time. So it can go on forever. And every defense spending above of 1% of GDP is not under the restrictions that we usually add. And this allows us to channel the funds more clearly into production that is innovative. I fear at the moment that in order to spend as much as they can in the beginning, they will be backward oriented. Yeah? So by ammunition, of course we need ammunition. We are not having that much at the moment. We need tanks, we need ships, and so on. But it is much, much more important to consider, first of all, and then to realize that we have to look forward.
Yeah, of course.
And also think about the possibility to establish the systems on which we currently totally depend on the US. Think about satellites, for example. This is one possibility that we could expand to a larger extent than we currently have.
At the European level?
Well, it could be done at the European level. At least it should be done in coordination at the European level between us. I should mention one point here, given that Germany is now going forward with this large defense spending. The last 80 years after the Second World War were also a period in which the European allies as the Americans were eager to restrict Germany to a larger extent, not to become that powerful in defense anymore. So it's also important regarding the interdependence in the structures that we have, that we are cooperating from the start in order to ensure that no tensions are arising. And therefore, the German-French collaboration is very, very important in that regard. Yeah, it's very important.
Yeah.
I'm sitting as a Swiss in the middle, Swiss and Italian.
No, I'm not very, no, the Swiss are great.
So I want to open to the floor almost immediately. So let me just ask you one last question from my side. And the answer should be, please, short and basically one sentence, maximal 1 comma. Fast forward 10 years from now, let me offer 2 scenarios. One is the EU uses this momentum and this pressure at the moment and succeeds. We have 10 years from now a much more integrated, stronger EU, well on the way of also integrating further countries, and we have a credible defense and strong growth. And the alternative scenario, you put a no in front of all of those. So which scenario? No,
Yeah.
I ask you first because you're the optimist. Which scenario do you go for?
I'm usually in the middle. At least I hope that we are sufficiently able to restrict the current geopolitical tensions that are present in order to ensure that there is no direct conflict between the large powers. If this is the case and we go through this successfully, I hope that we are going to get, less restrictions in trade, realize or profit possibilities or business possibilities in the world.
In the world or in the EU?
Not only in the EU, but also in the world.
But a stronger EU?
Yeah, well, you have to have a stronger internal market anyway in order to increase productivity. We have many, many restrictions. Think about services, think about the financing side. So there's a lot to do in that regard. And this is not only the gold plating, it's also the regulation that is coming from the EU.
Sorry, I didn't want to.
Yeah, well.
Just wanted you to be on the one pessimist-optimist spectrum.
Yeah. And my view, I will tell you. I'm a fighting optimist. I'm thinking as long as there are things you can do, you can be optimist. I think you become really pessimist when there is nothing you can do. And when I see Germany becoming an investing country again, when I see UK getting back to us, when I see Canada, we are very close to Canada. Canada is not in Europe, but we are very close. I mean, we share very much the same values. And I see all these scientists in the US, they are very unhappy because the scientists, they want 3 things. The soft power. Now we are the stronghold. We have the soft power. And what are the big values that European represents? We are the hallmark of those. Freedom and democracy. It's us now. Now there is no more. You know, I had a colleague in the US. He got a prize, a nomination for a prize in France. And he was being interviewed by Le Monde. And he didn't dare to give his answers, Britain. He was afraid. Adrien B. And he gave them by orally because he was scared. People are scared now in the US to speak. Now, the only place in the world, but Canada, of course, is with us, but the only place where you are free and democratic, it's Europe. Number 2, protection and inclusiveness. We have a social model, okay? We can reconcile innovation and inclusion. I mean, we know, and that's what we want. We want to become more innovative, but by also improving our social model. And the third thing, we have a true commitment to fighting climate change. And I think that will make us very attractive. You know, when you're a researcher, you don't want to earn billions. You want to be able to earn correctly, but you want to have good schools for your children, good health system, and be in a country where you can freely speak without being arrested, without having your phone, scrutinized, without knowing whether your students will get a grant or will not get a grant, will get a visa or will not get a visa. And you worry about climate. You want to know also which climate your children will be. That place is Europe. So we have this place. We have good, fantastic mathematicians, engineers. It's up to us to do it. We can do it. And I'm very optimistic.
So how can we top that? Well, audience, up to you. Who would like to? Yes, start.
Well, first of all, thanks for a fantastic discussion. I would like to talk a little bit about the productivity divergence between the United States and Europe, which has been widening in the last 25 years and likely will be exacerbated. We just came out, I'm from the OECD, we just came out with a paper on the impact of AI on productivity. And we do this for the G7, and we see that certainly countries like France, Italy, that were further behind on the impact of productivity and the diffusion of AI. So, what does this mean? In particular, what Philippe was mentioning on the role of universities, this is absolutely true, but we also know that AI is a bit different in a way that there are some deep pockets in some of the conglomerates. There's a very nice book by one of the pioneers of AI, Fei Li, and she says very clearly that she was in Stanford and she was in Duke, and she went for a sabbatical in Google and said, listen, I never thought that we could have this type of research funding at our disposal and our resources. So perhaps, is there a change? So what I would like to ask, besides the divergence of productivity, is if, for example, one of these big conglomerates gets to AGI first than anybody else, will this mean that Europe is irrevocably behind in terms of AI?
So on AI, I'm not a kind of top. I worked on an AI report for Macron last year with Anne Bouvreau, who organized the AI summit. AI now, it's data and computing power. There are areas where we have very good data. For example, on health in France, we have fantastic data. We need to build up computing power, and that's where there is a role for the state. That would increase competition. If we have local computing power, local data centers, and there is private-public investment, that will foster entry in competition. So there are areas where we can really develop AI, because there is all the application, and we have the data, and if we build computing power, and we have the engineers, and there are many researchers in AI, they would come to Europe if we give them good conditions. You see what I mean? Even Google employs researchers in Europe because they're happy in Europe. So all what I said before, if we have this laboratoire d'excellence and more money for research, but also we have the computing sector, the data center, computing sector, if we build the equivalent of CERN, you know CERN, if we have a CERN for AI, for example, we can do all those things. People will come because we are heaven. Europe is heaven, and they will come to work with us. If we make it easier to have you work part-time at Google, part-time public research in AI, we can attract Yann LeCun, who is a pillar of AI. He's a very good friend. He loves to come to France all the time, and he's not happy in the US anymore. If we create the minimum amount of attractiveness in Europe, LeCun will be with us. He already believes that LLM is behind us, that now you go beyond LLM. You have to bring all the Yann LeCun, and they will work on the next generation. So I think we are totally on the race.
Okay, thank you. So now I want to take a few questions. Please make them short, and then we go back to the panel. So Isabel was first, then climate, and yes.
And yes.
So I have first of all, thank you very much for a fantastic panel. It was really enjoyable listening to you, and thanks also for the optimism. So I have a question to Lars. So you used to say that common defense is the basis of the foundation of states. So my question to you is, would common defense be a first step towards the United States of Europe?
Mm-hmm. Yes, can you have it?
Hi. Thank you so much for the great discussion. So I had a question about climate policy and industrial policy. So here, you were talking about that in the standard theoretical framework, you want to tax carbon to avoid fossil fuel, and then you also want to stimulate innovation by putting green subsidies. I tend to agree with you from the theoretical model. That's kind of the nice outcome. But then it kind of, I share some of the points that were shared before, like you're always looking back, like now obviously solar panel and windmill are very obviously what you should invest in, but then or do industrial policy. But then if you do that, maybe you're subsidizing a bunch of companies that may never invest and innovate and find the next innovation that could be useful for the environment. And so I was wondering if there's a way for both of you to reconcile what, looking to the future and trying to promote future innovation at the same time as being a bit more conservative and not, inducing misallocation and spending, public spending on bad innovation, on bad technology. Thank you.
Thank you.
Adriana Kugler from the Federal Reserve Board. Thank you for the very dynamic panel. So I appreciated very much that you focus on innovation, access to capital, government spending or investments in spending. But I guess I was surprised that there was no mention to immigration. And there was no mention either to business dynamism and entrepreneurship. And I would say those have been two of the main sources of growth in the US and in productivity growth, in particular TFP, in the past few years. So I was wondering about your reactions to that, especially in light of the different reactions to immigration across Europe, with Brexit, with continental Europe also facing different reactions to immigration and backlash in different places.
Okay, great, thank you. Last, military.
Starting with Isabel. Well, actually, when you look at the history of the formation of federations, usually you find that the defense question stands in front of this development. Look at the US, you can look at Canada, Switzerland, Germany, these 4 of, say, 6 traditional federations have something like this. And therefore, defense is so important. But it is not simply buying weapons coordinated at the EU level. What you need to keep in mind is that they had common armies, and the willingness to give up sovereignty to the EU level in that regard, where you bring some of your citizens into danger being killed at the front, is a very difficult question to solve. And if it is solved, I would say it's the first step, the first clear step towards the United States of Europe. And then regarding defense in general, you would say the proper way of financing it is if there is a sufficient amount of spending of defense at the federal level in the EU, then you need also have to have a kind of tax that is financing it. It's not only indebtedness that will help, you need to have a proper EU tax and sufficiently relevant in order to finance these large amounts of defense. Let me make one remark in the direction of immigration, business dynamism, and so on. Particularly when you mentioned CERN, I remember visiting CERN this year and being informed about all the inventions that came from CERN and finally made it to the US and were used in order to create innovation in the US. So it's still this problem of translating the inventions that we have, the patents that are created in Europe, and translating it to the market and have the innovation there. And what we discussed in the beginning of this meeting, labor market regulation is one element, product market regulation is one element, but we never know how much preferences as a third variable influence this. And there is your business dynamism that you mentioned. So when children at school think, what is the next firm that I can found? What would be a nice startup in order to get some money? And the school children in the US start with it at the age of 14. In our case, the school children at the age of 14 think differently. They try to find out what would be the next good job in government. And that's a different thing. And so I think we need to do quite a lot in order to improve this environment and allow for the innovation. It's not simply that the government can trigger this. At some point, you must be sure that you are unleashing the innovators in order to give them the space to innovate.
You must be talking to different school children than I am, but who want to go and work for government.
So no, just to answer the questions. I mean, on energy, I think you're right. I mean, that's what DARPA also allows. DARPA, it's co-financing public-private. So if something doesn't work well, it's not refinanced. So that's one thing that DARPA enables precisely. It's to make sure you don't pick winners and you stick with the winners. That's one of the big things that DARPA does, okay? And that's where we have to move it. On the business dynamism, exactly when I mentioned you need a single market, You need venture capital. You need, I'll tell you, institutional investors. I spent 25 years in Boston as a student and then subsequently as a professor. I saw many consuls de France in Boston, in a row. They would tell me my main job is to welcome French startups that cannot grow in France because they don't have the financing to grow. They don't have the venture capital, the social investment. So if we create this financial ecosystem, that's what will spur business dynamism. You have to create a climate where you can create a new firm, not be over-regulated also, because we are very good to over-regulate. So in AI, it's a big issue, by the way. We need regulations, but we tend to over-regulate, okay? And you need to have a framework that encourages startups and them to grow, you see what I mean? And that's business dynamism. I mean, that's absolutely key to the whole thing, okay? Migration, there are some people in France, I think for demagogical reason, they think we should have zero immigration. I think those people are disqualified to become ever president of France because, and I don't put name there, because you need immigration. You need, of course, skilled immigration. You need to pilot your immigration policy. But the idea that you should have zero immigration, it's totally absurd. If you go to a French hospital, by the way, and you didn't have the Romanian or other people, doctors, you would not be cured. It would be absurd. You need smart, and you need to renew, because we have a demographic problem. We tend to be aging. The big problem of Japan, why isn't Japan innovating? Because they're becoming older and they don't have migration. We don't want to become like Japan. We want to have an economy where we allow for smart migration. So migration, and more generally, it's like business dynamism. We need entry. We need entry of talents, good education system. We need good regulation, but not over-regulate so that not to discourage new entrants. We need new blood. I mean, the success to growth, the key is to have all the time new talents, new firms, new blood coming in. Everything that blocks the new blood is bad.
So we are actually running out of time very quickly. So I have already allowed 2 more very short questions, please, and then 2 very short answers.
Marcin Kacperczyk, Imperial College. I have 2 comments. One is the story of financing. I mean, it sounds like, okay, finance is all that we are missing. I think we have to be a little bit careful.
No, that's not what we say, yeah?
Well, I think kind of very targeted policies are very important. But maybe more important, I think the interesting question I have is, how should we align the timing of all of this? Some of these ideas, especially you mentioned, sound more like a medium to long-term kind of investments. I mean, revising the whole kind of educational system is not going to happen overnight, even if this brilliant economist or whoever else comes from the US. But the problems we are facing oftentimes are very short-term. Think of like climate change. I don't think we have that time kind of luxury we had with iPhone, that it took like iteration of iteration to design the product that is finally really good and we can use. We need solutions which are basically now and very soon, rather than the solutions that are going to arrive 10, 20, 30 years later. So are there any kind of changes we need to adopt? Because some of these things may simply misalign with what the objectives are in terms of timing when they need to
Okay, urgency and
timing. Very quickly.
Afterwards.
Yeah.
Thanks. I'll try to be short. So it's a follow-up to Isabel's questions. We tried actually in Europe to start with defense, and the European defense community was essentially voted down by the French Parliament in '54. So my question is for Lars. I mean, do you think that we can achieve a single market for defense if we don't have joint procurement? Because that would tend, according to political economy literature, to keep vested interests that are fragmented along national lines.
Okay, Philippe, you're...
No, my response quickly is that you have to start everything at once. Some of the things will yield short-term return, but the long-term you have to start right away. Also because people anticipate, very often long-term policies their effects are anticipated, and so you get gains. But the gold plating, that you have to act, creating a European laboratoire d'excellence, that's something that can be done quickly. Having some countries in Europe get together, create a DARPA or create joint projects, that can be done very quickly. And education, of course, takes longer, but you have to start right away. So you start various things. Some of them gives you a return sooner, but you should not delay those things that you think will take longer.
Thank you.
Yeah.
Last defense.
Two short answers. I think it would be a very important precondition to have joint procurement in order to come up with a defense union. I know how difficult the political economics behind it is and how strong currently these special interests that come from particular firms are. But given the fact that we need to have a quick rearmament and that some of those firms are already producing at their capacity constraints, having difficulties to expand capacity, I think we could do much, much more by cooperating, despite everything that might hinder this. And this is also going in the other direction to the other question. When you are doing this properly from the start, you are somehow managing expectations, and this has an effect.
Thank you. Thank you to both of you, Franco-German excellence and efficiency. We have exhausted our time. Thank you to everybody. A big applause for our panelists.
Thank you.
Well, thank you very much for what I think Governor Kugler very aptly described as a dynamic panel. I feel as though you guys really did your bit to close the productivity gap over the past 45 minutes. We now come to the final part of our program, the presentation of the award for the best paper from one of the world's most promising young economists. The winner has been selected by an expert jury and also taking into account your votes. It's now my pleasure to hand over to ECB President Christine Lagarde.
Okay, I can do without it. So good afternoon to all of you. And it is really my pleasure today, just like last year, to convene the finalists of this award. And we are every year reminded how important it is to listen to these young, talented people, not just because they are our retirement program. We heard a bit about aging on this occasion of their presentation, but also because they are the future of our profession. And amongst them, I'm sure that there will be future governors, policymakers, academics, or whatever they care to choose, because they have so much talent. So, I had a chance, as I'm sure you all did, to walk around and talk to some of them and have a look at their posters, and I'm sure that some of you will be reading their papers. But being here is already for all of them an impressive challenge and an impressive achievement. I'm looking at all of you there. You are, in this corner of the room. Because there were over 80 applicants this year. So for the 10 of you to be in this room, to have shared those few days of debates and those social moments, I know some of you enjoyed the dinner last night, and I'm glad that you were with us, is really an achievement. You are the winners, all 10 of you. Your papers really underpin the theme of this year's forum and the macroeconomic shifts that we continue to observe in our work as policymakers. Over the past few days, a selection committee has been very busy reading, evaluating your papers. They reviewed their academic quality and policy relevance, and also took into account the votes of the participants through an online voting portal. Thank you to those of you who have participated in that vote. So let me first of all, before I call you up to the stage so that you can receive your diploma, so to speak, let me first of all thank those who spent time reading and evaluating your paper. They were the selection committee members, so Jordi Galli, Ellen Ray, Philip Hartzman, Isabel van Sinkist, and Francesca Zucchi. Please stand up to be recognized by this room. Thank you much. I would like to now ask you to come to the stage to receive your diploma. We're going to proceed a little bit differently from last year. So each of you will receive his award, not the final award, but there's award, and there will be a photo opportunity. You'll have to move swiftly because the 10 of you will go through this exercise, and the audience is very keen to get out and do something else. So, who do I announce? So Thomas, I have to stay here because otherwise nobody hear me. So Thomas Bourani, here you are. Adapting to change, macroeconomic shifts and policy responses. And I think you win the prize of having said hello to as many people as you did in the last 24 hours. Thumb up.
Thank you very much.
And now I call to the stage Leonardo D'Amico, one of the many Italian elegant beneficiaries. So your theme was adapting to change, macroeconomic shifts and policy responses. Thank you so much. I'm now calling to the stage Frédéric Fournet. Adapting to change, no, that's okay. Yeah, no, you stay close to me. Adapting to change, macroeconomic shifts and policy responses. I saw many, many people at your booth over there listening and trying to understand the great work that you've done. So now with adapting to change, macroeconomic shifts and policy responses, Marco Irisari. If I pronounce it right. Thank you so much. So Patricia Massner, adapting to change, macroeconomic shifts and policy responses. Bravo. There is a problem here. Because this one is also adapting to change, macroeconomic shifts and policy responses. This is not that. Lovisa Reiche, and I know this is not it, because you are the one who focused specifically on how gender differences actually matter when it comes to inflation expectations. So the title is wrong, but the study is great. All right, Giovanni Ciacovelli. Congratulations. Thank you so much. What am I doing? Yeah, okay. So now I call to the stage Jacob Marot Sondran. Congratulations. Okay. And now Giovanni Trebi. Last one, Alena Wabic. There you go. So it's now for me time to announce the winner of this year's Young Economist Prize, who will receive 10,000 euros and the trophy that will be presented in a microsecond to me. Thank you, come over, because I have to hand it over to the winner, who is Alena Wabic.
As Madame Lagarde already said, I'm sure you're all happy to leave, so I'm going to keep it short. Thank you so much. I'm deeply honored, especially because we've seen so many excellent projects the last few days. So I think we can all be proud. And thank you so much for letting us share our work.
Bravo. Fantastic. Well, thank you so much. You can stay here, enjoy the moment, because, seeing all these very, very bright policymakers, professors, researchers of all walks of life from where you are is a moment. So keep it. Stay here. So we are now coming to a close, and I owe it to my great team to have quickly summarized what we have done over the last 2 days. And I thought I would remind you briefly. It's going to be short, I promise. So we started Tuesday with a paper on eurosclerosis in the labor market that was shared by the Vice President. And the paper questioned whether over-regulated and rigid EU labor markets are contributing to low euro area productivity. And not all of you in the audience actually agreed with those conclusions. The second paper caught the attention of the media in the room by suggesting that central banks should look at discretionary spending as well as headline inflation, not to be confused with core inflation, although there was a debate on that. Under the supervision of Frank Elderson, that provoked a very lively debate, not least because discretionary spending is done disproportionately by the rich, a 4-word letter that Ajay Banga told us we shouldn't use anymore. Our first panel on Tuesday was focused on heterogeneity and on the implications for monetary policy transmission of different economic structures in euro area countries, brilliantly shared by Isabel Schnabel. And of course, we had an engaging and high-powered policy panel with Jay Powell, Andrew Bailey, Kazuo Ueda, and Ri Chong-Young, which I hope I also contributed to a little bit. But I can assure you that all participants who have had to leave earlier have said that they have enjoyed it tremendously, as I hope you did. I would also like to thank, of course, the Young Economist finalists, because not only do you all look fantastic with your diplomas, but you gave us those really sharp, acute, and very bright and quick presentation of the work that you do, and that is a real challenge. This morning, we kicked off the second day of the forum with a paper on non-bank financial intermediaries and the extent to which this wide variety of various animals might be able to contribute more to European growth, as well as the risk to financial stability. We followed up with a paper and discussion on trade, the buzzword of 2025, not to be confused with tariffs, and what the changing structure of global trade means for Europe, shared by Piero Cipollone. And today's panel discussed the challenges of central bank communication, or as Philip Lane noted, channeling Ben Bernanke, whether it is a 2% action and 98% talk or something else. The view from central banking, academia and journalism taught us about the pros and cons of scenarios, the need to target different audiences with consistent messaging, and the relevance and limitation of artificial intelligence. And we have just ended with this mix of Philip's passion and enthusiasm together with Lars' pragmatism and focus on what will it take. So I could not conclude without thanking all of you, the moderators who have done a fantastic job harnessing the talent of the participants, and all of you who have asked questions, and those of you who have not asked questions, because you have clearly paid attention to the last hour of this great conference that I would like to mention will be held next year from June 29 to July 1st. And that will save us having to have the policy panel on the first day, because what we did this time around was to allow some of our American colleagues to return to Washington for their July 4th big celebration, is we had the policy panel on the first day. Next year we will have it on the second day, and that will be in line with the tradition that we have had. I'm not going to say more at this point in time. I would simply note for the record that the organizers of this conference, under the leadership of Isabel Schnabel, Luc Leven, and Philip Hartzman, have managed to almost bring this participation to absolute parity. 11 women, 14 men, between the moderators and the participants, whether on panels or otherwise, is actually something that very few economic conferences managed to deliver. So to them, thank you so much, and thank you for the fantastic work that you've done assembling all these smart people together. Thank you, and see you next year.